Order the Board of Retirement meeting for Mendocino County for the February 15, 2023 meeting. We can start with the roll call, Ms. Zeller.
Ms. Covison?
Here.
Mr. Hawkins?
Present.
Ms. Cavanis?
Here.
Mr. Jurdy?
Here.
Ms. Smith? Here. Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris? Here. And Mr. Anderson will be absent.
All right. We'll stand and do the Pledge of Allegiance. Trustee Hawkins, would you lead us?
Certainly.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Sounds a lot better in this room.
And just a reminder to speak up, and we're using the meeting owl as our mic. So you'll want to direct your voice to the owl, please.
Thank you. At this time, we will allow members of the public to address the board on subjects both on and off the agenda. I believe we have some people in attendance. I don't know if anyone would like to make any public comment at this time. Understood. Anyone online that would like to make?
There is no public comment at this time.
Thank you. Item number 1 is regarding the adoption of resolution 2023-04 authorizing teleconference meetings pursuant to government code section 54953 and in compliance with Assembly Bill 361. Is there any trustee discussion or comment on this item? Move approval. Thank you. We have a motion and second. Any further trustee discussion regarding this item? Any public comment?
There is no public comment.
Thank you. If you would take a roll call vote, please.
Ms. Covison?
Yes.
Mr. Hawkins?
Aye.
Ms. Cavanis?
Aye.
Mr. Jurdy?
Aye.
Ms. Smith? Aye. Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Aye. Approved.
Thank you. That takes us to our consent agenda. Item number 2. All matters on the consent agenda will be approved by unanimous consent unless a trustee would like to remove one of the items for further discussion. Hearing no conversation, we will accept those under unanimous consent. Leads us to item number 3, discussion and possible action regarding investment matters. I believe item number A related to Financial Investment Officer, Mr. Reveles.
Morning, trustees. Yes, you have before you a short memo that briefly outlines some considerations that not only Callan will mention and has mentioned in the report, but that up front we wanted to put to the front of trustees' minds as we review the asset liability study. We've got Gary here who did the study, and Greg online. I see Greg, and we've got Claire and Hannah with us as well. So we'll let them take it away.
Okay, great. It's great to see you all. Sorry I can't be there in person today, but the smarter people are in the room with you. Anyway, so today we're going over the asset liability study, and we've been previewing this with you for the past few meetings. We first shared with you our capital market expectations, and then we collected a bunch of data from your actuary. And now we have the results to share with you today. And we do this type of study every 3, 4, 5 years on a recurring basis because it's part of a good fiduciary process, one. But also we do it periodically when your liabilities meaningfully change, your contribution policy meaningfully changes, or investment outlook meaningfully changes. So that's why we do the asset liability study. It's really important because it's the bedrock of your investment policy going forward. And we want to make sure your investment policy is going to put you in a position to succeed going forward. And to me, there are a few big takeaways from the report. Gary's going to walk you through it in detail. But one of the big takeaways is that we believe you are in a position to be successful going forward. And really, it's for a couple reasons. One, you have a very solid contribution policy. And that contribution policy is really important for you. It's going to put you in a position to succeed as you maintain that policy over time. So that's the first reason we think you're in a position to be successful going forward. The second reason is investment returns. Our forecasts is a lot better today than it was 24 months ago, 12 months ago. Because last year was such a tough year, in particular for the fixed income markets, our forward-looking return expectations are a lot higher today than they were previously. That means your expected rate of return, as Callan calculates it, is now greater than your discount rate. And we haven't seen that for a long time. It's been a long, long time since we've seen that. So we think that puts you in a really good position to succeed going forward. But it also means to us that you don't have to take on a whole lot of investment risk to try to close the gap. The capital markets are giving you a better opportunity to achieve success today without taking on a whole, increasing your risk posture from where it is today. Another key takeaway from the study, in my perspective, is that your liquidity needs are quite manageable. You are making a lot of benefit payments, but your contribution policy comes close to offsetting that. That means that your percent allocation to illiquid assets, which has increased over time, is quite manageable for you, right? You can manage your illiquid assets when you look at both your distribution policy and your contribution policy. Another key takeaway for me is with the return expectations going forward, we don't think you have to add private equity because we think you can get to the same destination with just public market assets and your real estate and infrastructure portfolios, which you've been building out over time. We don't think you have to add private equity to get to a good destination. And without private equity, you don't have to deal with the costs, the fees, the administrative headache, and the reporting headache associated with it. And then the final takeaway for me is that you have kind of a low allocation to fixed income relative to some of your peers, which, okay, that's an interesting data point. But the corollary to that means that you have a lot of other things. You have a lot of equity risk in the portfolio. And which brings me to kind of the final takeaway, which is that what you're doing today, your current investment policy looks good, but if you do anything, perhaps you take a little equity risk off the table and you add a little fixed income allocation. To me, that's kind of the key takeaway. So before handing it over to Gary to walk you through the details, I just kind of wanted to share with you kind of the few takeaways. And then Gary will walk through it, and then we'll get to the end, and we'll talk about the different asset mixes. Does that sound good?
Okay.
All right.
And
Gary, take it away.
Share screen?
Yeah, go ahead and share screen. Perfect.
Great. Thank you, everybody, for having us today. It's so great to see you guys in person as opposed to virtual last time. Just to kind of set up the stage here, Greg did a great job introing, but we last met in November of last year to talk about the asset liability project, what the goals and objectives of this project are, and sort of Callan's process around it. What are we going to be doing in this project? So in terms of the goals for today, we'll walk through the completed project now that we've gathered all the information and run the analysis and the numbers and share with you our observations and our recommendations, which Greg just mentioned earlier. So the first part of the study that I'll cover is on your current financial position. We'll take a look at your plan characteristics as of the most recent date from your actuary. And then we'll take a look at some projections for your current portfolio, looking at things like funded status over time, contributions over the next 10 years, and liquidity, which Greg mentioned as a very important thing to look at. And then in the second section, we'll cover what could you do differently, right? Consider alternatives that maybe increase the amount of fixed income, take a little bit less risk, and we'll also look at an alternative that takes even more risk. And that's more as an illustration. We're not recommending that you take more risk at this time, but just sort of as an illustration to see what would happen if you were to do so. So feel free to jump in at any time as I go through these results, but that's kind of a broad outline. And from our perspective, we think where you are, just to reiterate Greg's point, where you are today is completely appropriate, given your investment objectives and your financial condition. Maybe let's just jump in. Page 7. So the takeaways from our meeting last time in November was we were going to finalize our 2023 capital market assumptions. My colleague John Perrone recently met with you all to cover the final assumptions, and we've run those assumptions through your current portfolio here. And so the expected return on your portfolio is 7%, which exceeds your discount rate of 6.75. So that's a very positive sign in our opinion. Your financial position, this is as of June of last year, was about 71% funded. And as Claire and Hannah will cover in a moment, your position as of December, or just more recently, is about the same as it was last year. So not much has changed from June of last year from when we did this analysis. And then another key takeaway on page 11. Well, thank you. That we were going to obtain information from your actuary, Siegel. Okay, so we're going to use Callan's capital market assumptions and then marry that with Siegel's liability projections in terms of your funding policy, benefit policy, and all these liability assumptions. And we're going to marry the two models and project out into the future some asset liability. So we've gathered this information from Siegel, all the participant data, and integrated that into our model here. And I'll just cover a few of the key metrics here on this page. I won't go through all the numbers here. We've talked about the discount rate, very important, 6.75, which is on the bottom of this page. And then maybe covering some of the key numbers up at the top table. You are roughly 71% funded today. What that translates to in terms of dollars is a deficit of about $230 million. And that's being amortized. You're paying down that deficit over the next 18 years, as I'm sure your actuary has told you before. And so what that means in terms of contributions is that a lot of money is coming into the plan. Right? It's a very strong contribution policy. Employer contributions from the county are about 37% of payroll, and we project that's going to stay around some 37% over the next 10 years. Employees contribute, as you know, part of the normal cost for the ongoing accruals for the active employees in the plan, and that's about $10 million a year, $9 to $10 million. So in total, when you take employer and employee contributions into account, that's about $40 million that's coming into the plan every year. And so that's a key input to the modeling here. Maybe let's move on to some projections. So here what we're showing is a forecast of liquidity, which we think is very important to look at. Spend a moment explaining this chart here. The light blue bars represent the total contributions that I just mentioned, employer plus employee, which is about $40 million a year. And we project that to increase slightly over the next 10 years. The benefit payments are shown in the dark blue bars. And so those are benefits being paid out of the plan, and those are slightly more than contributions at about $45 to $50 million per year. So from a total net outflow perspective, you are slightly cash flow negative, right? More money is going out of the plan than is coming in on a net basis. But if you look at the percentage that net outflow represents, it's about 1 to 2%, and we think that's very manageable. just as a data point, when we look at your peers, we oftentimes see percentage of net outflows at 5 to 6 to 7%. So 1 to 2 we think is very reasonable, and it supports your current allocation to the liquid assets at 70% in private real assets. And then moving on, I'll just cover one more chart here before we talk about alternatives. Here, what we're showing is your projected funded status over the next 10 years. So you're starting out at 71% funded, and we expect the funded ratio to improve over the next 10 years to over 90%. And the reason we see this improvement is, if you notice, the assets in the light blue are growing at a much faster rate than the liabilities are growing, which is the dark blue bars. So because assets are growing much faster than liabilities, we see an improvement in your funded status over time. And one of the key reasons, as Greg mentioned earlier, why that the assets are growing so quickly is because of the contribution policy. It's very strong. You're contributing $30–40 million a year, and that's really propping up your funded status over time. So actually, let me pause here before I move on to the alternatives to see if there's any questions on your current position or your funding policy or any of the results that I've shown so far.
Chair,
Yes.
I don't have any questions, but this is good info, and you presented it very clearly.
Speak towards the owl, please.
Oh,
Okay.
sorry, I just said it was really good info, and it was presented very clearly, and I really appreciated that. What I'd never seen before was the abbreviation for employer and employee. EE and EUR, and it sounds like Eeyore and Winnie the Pooh, but I've never seen that. I'll have to start using that.
To do is just to save a little bit of space on the chart.
We have trustee Jurdy, go ahead.
Yeah. So before we get to alternative asset allocations, I'm kind of question about our allocation within the equity area. And so at the last meeting, I pointed out that in past performance, of course, it's no guarantee for future performance, but in past performance, large cap value companies performed pretty closely over the long term with the S&P 500 or total stock market, but their drawdowns in down markets were less, so there was less downside. And my point was, well, maybe if you had more downside on your equity portfolio, then you would be less reliant upon bonds or alternatives to stabilize the fund, because of course we have monthly payments going out. The other question I have is, are any other public pensions that you advise or private, I guess, foundations, do they have any variation within their portfolio of equities? In other words, do they always just sort of stick with the broad market because that's kind of the safe thing to do, to just stick with the total stock market? Or do they sometimes have a variance from the total stock market? So for example, the health industry, I've been reading about it a bit, and it's even more uncorrelated with the stock market than large value cap in general. So when there's downturns in the economy, the healthcare industry keeps chugging along more or less unimpacted by the downturn in the economy. So it doesn't have as much of a downside when there's a downturn in the economy. And they seem to have spurts. Looking back on backcasting on Portfolio Visualizer, it's about 1 out of 3 years, and usually it's clusters of 2 or 4 years, where it dramatically outperforms the stock market. So it seems to have a correlation where it tracks with the stock market over a 20-year period, except that about 1/3 of the time it dramatically overperforms, and on the downside, it doesn't seem to drop as much as the total stock market when there's a drop in the market. So I'm just wondering, is it foreboding for a public pension to have any skew in its portfolio where it just needs to go, it's just assumed that you need to go with the total stock market? Or can you skew it, and instead of, let's say if the total stock market was 15% healthcare, you might have another fund that's maybe representing 15% or 20% of your total equity allocation that's a targeted fund just in the healthcare industry, maybe even an actively managed fund that's going that's investing in, like Vanguard has with Windsor, that again seems to be performing about 1 out of 3 years well above the market, with the market the rest of the time, and on the downside it doesn't seem to have the downside. So I'm just asking, is that something that is allowed for a public pension fund, or is that just seen as too risky?
So I'd say that it's, I mean, quote unquote, allowed, but generally not done. And it's, but the way we kind of look at it is you've got about a quarter of your assets in S&P 500 index fund. And that expression is that all of those things you mentioned, Dan, which are all very good points, all of that is reflected in the price of the securities in the market. It's the efficient market hypothesis, right? And that's why you buy an index fund. You know, the Vanguard has as much active as passive, probably more passive than active. So you've got that index fund. But let's say someone can anticipate that healthcare is going to do better or value is going to do better than growth. Then you allocate that decision to someone who can make the decision quickly and in the market all the time, right? Not a strategic decision by the board. The strategic decision by the board is, I'm going to pick those managers to go make those decisions for me on a tactical basis. And we do that with the U.S. small cap managers. So you've got 4 U.S. small cap managers who are active, and they can go in and they could overweight healthcare, underweight healthcare, depending on what's priced in the market today. Is regulatory change going to affect the healthcare market? Will growth rebound now that interest rates are higher, and it won't just be value? So we allocate that to the small cap managers in the portfolio, and you've got 4 of them. And then the international equity managers as well. We've got 6 of those. So those are the managers who we delegate that more tactical management to, and it's not a policy decision by the board.
Well, I guess I was looking at more of a strategy and not tactics. I mean, I wasn't looking at people bouncing around from one allocation to another, one industry to another, but taking the long view that I'm just saying superficial research by one board member. That the healthcare industry seems to be growing faster for a multitude of reasons, because of the aging population of the Western countries, the developed countries, and just new innovations in the healthcare industry. So we're not necessarily talking about investing in hospitals. You're talking about investing in the kind of leading edge of the healthcare industry. Again, it seems like there are some actively managed funds that have specialized in an area, and I'm just saying anecdotally, looking at the Vanguard actively managed fund with Wellington, it seems to be tracking very closely with the total stock market 2 out of 3 years, and about 1 out of 3 years substantially overperforming, but without the downside of the big drops that come in the S&P 500 or total stock market when there's a downturn in equities.
Yep. All fair points. All fair points. And some of the managers we have, they'll take a long-term strategic position on a security and hold it for 4 years and wait for that thesis to play out, wait for that healthcare thesis to play out over time. But we delegate that to them, because they also, they get the thesis, but then they also have to make the assessment, well, what's priced into the market already? And so we delegate that to other people to make that decision for us.
So they see, you're saying they see a 4-year time horizon as long view? I mean, I see long view as 20 plus years.
I mean, could be 2. I mean, to me, 20 plus year is stocks will beat bonds. That's what we're doing. 20 plus years, stocks will beat bonds, and that's why we hold the stock portfolio. But, one thing I'll point out is today our discussion, Dan, is really focused on how much money should we have in stocks versus bonds. And then after this study, we can take a deeper dive into each asset class and say, why do we do what we do in each asset class? And should we be doing something different in the bond portfolio, the equity portfolio, et cetera.
I'll just add something real quickly to your comment, Greg. So today, when we look at the alternatives, we'll look at different levels of fixed income versus equity. That's the most important decision, right? And what that equity looks like, whether you have a small cap or value or whatever, bias you want to express, that's done at the next stage of the analysis. So. All right. So if it's okay with everybody, we'll move on to look at the alternatives. So your current portfolio, we're showing on this table on the left-hand side, which is labeled Mendocino target. So 21% in fixed income is the key number on this table. And the expected return on your portfolio is 7%, like we mentioned earlier. And we're showing some alternative mixes on the right-hand side of the table, 5 labeled mix 1, mix 2, all the way to mix 5. 3 of these mixes, mix 1, 2, and 3, are alternatives that have higher allocations to fixed income, so more conservative. Right, so mix 1 has 35% in fixed income, mix 2 has 30%, mix 3 has 25%. And as I mentioned earlier, we are showing one more aggressive mix compared to your current portfolio, which is mix 5 at only 15% fixed income. And that's more as an illustration. A couple key takeaways from this page is if you look at the expected return on more conservative portfolios, mix 3 and mix 2, the return on these portfolios actually both exceed your discount rate. So 6.8% and 6.9%. So what that tells us is there is potentially some room to take some risk off the table, dampen volatility going forward. So we think that mix 3 is attractive because it still exceeds your discount rate and increases fixed income from 21% to 25%. And the other thing to note on this page is that we are not looking at private equity on this page. So these are only using your current asset classes. I will show some results downstream, what would happen if you were to add a little bit in private equity. But for the results that I'm going to show you in the next couple pages, these do not include private equity at all. Okay, so looking at the results for both your current policy as well as these alternatives, mixes 1 through 5. I'll spend a moment explaining this chart. It's a little bit different from what I was showing you earlier. In the earlier charts, I was showing you a single scenario projection. Let's say you were to achieve 7% return every year, right? That's just a single scenario. And what we're trying to show here in these charts here is we know that there's a lot of volatility around your investments, right? Stocks could be up or down any given year, and we wanted to capture a range of results, not just a single scenario. So what we're showing you here is a range of results, a range of funded status over the next 10 years, at the end of the next 10 years. And so the way to interpret these results is, on average, the expectation is in the middle of these bars. So between the dark blue and the dark orange bar is the expected funded status at the end of 10 years. So for your target portfolio, which is the second bar from the right, if you look at the table, it's highlighted as the 50th percentile or the median result, and that's 94%. Right? So if you recall earlier, with a single scenario, your funded status is expected to be 94% on average. And what we're showing here is that that's only an average, and there's a wide range. It could be below, it could be above. So we like to look at both the average, which is 94% for your target, as well as a downside case, which we call the 97.5th percentile. That represents a very negative scenario, right? Probably stocks are down quite a bit in this scenario. So in that case, your funded status could fall to just above 50% in this type of scenario. We think this is useful to get a sense of the volatility, the range of results. So what can you do, right? You take more risk off the table, going to mix 3 or mix 2. You can see the bars are narrower, right? You're taking some of the volatility down. And so what that means in terms of a worst case or an adverse scenario type event is that a funded status could be slightly higher in a mix 3, 53% versus 52%. And if you were to go a little bit more extreme to mix 1, which is 35% fixed income, the downside is a little bit better there, like 56%. Now, granted, all of these results are very close to each other, right? And the reason for that is because all of these mixes still have quite a bit of equity in them. Right? So mix 1 still has 65% in equity in real estate and real assets. Now, we did take a look at something more extreme with 90% fixed income. Now, why wouldn't you do 90% fixed income? The reason is that expected return is going to be much lower, right? So on average, you're not going to be able to, maintain a high fund status over time on average. So that's sort of the classic risk return trade-off. If you take risk off the table, you protect on the downside a little bit more, but in return, you have a little bit worse of an expected outcome. So I think this is an important page to show you all. It just highlights the important point that investment policy is important, but contribution policy is more important in your case. The fact that $300 million, $350 million will be contributed to the plan over the next 10 years, that's what's propping up the fund status over time, not so much investments. Sure, it makes a difference. You can see there is a difference if you change the investment policy, but it's relatively minor comparing it to contribution. So speaking of contributions, on the next page, what we're showing is what do your cumulative 10-year contributions look like over the next 10 years. I mentioned that you're currently paying about, or the county is currently contributing about $30 to $40 million a year. And so over the next 10 years, we expect that number to be about $350 million for your target. If you were to take some risk off the table, go to mix 3 or mix 2, you can see the contributions in the expected case would increase slightly because you're not earning as much return. You have to put a little bit more money in. But the flip side of that is on the downside case, investments do a little bit more poorly. Less contributions are necessary in the more conservative mixes. So again, you see a similar trade-off there. So just to summarize, there's a lot of numbers on this page, but we wanted to compare the two portfolios we think are reasonable, mix 3 and mix 4. Mix 4 is your current portfolio. And you can see all the metrics listed here, but the key point is you're going to contribute about $350 million under your current funding policy over the next 10 years, and that's what's keeping your funding status high. You can take a little bit of risk off the table, and that improves some of the downside metrics here. And then we also show two portfolios on the right-hand side with private equity. I mentioned that we would be looking at private equity, what would happen if we were to add private equity, and we show that here in the numbers. And the important numbers to look at maybe are the funded status after 10 years, sort of in the middle of the table there. By adding private equity, you would end up on average about 1% higher in funded status at the end of 10 years. So we do see an improvement there, but it's not a very large improvement. So what that tells us again is that sure, you can kind of make these marginal moves on the edge here and add private equity, but we don't see a real compelling reason to do so. The numbers don't really support adding private equity at this point. So maybe I'll pause here. If there's any questions or comments from anybody.
If I can jump in, some of the conversations we've had about private equity, I believe some of the concerns, at least myself, and I think some other trustees that have expressed, are the fee structures and then potentially additional staff time needed by our personnel here to have that type of investment. I mean, is that taken into account at all in this analysis? Because our staff time hours are pretty precious with some projects we have going, and that's a huge concern of mine.
Right. These numbers don't assume that at all. So the 1% improvement With the trade-off there is more staff hours, more reporting requirements, more fees, and, just the patience to, ramp up in private equity. So that's actually a big reason why we don't see private equity as compelling, is because that 1% you earn does not take those things into account.
Thank you. Trustee Jurdy.
Again, just relying on portfoliovisualizer.com, but over the last 21 years, the total US stock market had its worst drawdown of 37% in 1 year and had its best year of 33%. This actively managed healthcare fund I'm talking about had its worst year of 18.39, had its best year of 43. Total stock market returns were 8.47 over the last 21 years. This actively managed healthcare fund, 10.34, 187 basis points of extra growth with far less downside. So my point simply is, yes, we can have less volatility in the fund by putting more money in low earning bonds, but we could also have less volatility in the fund by skewing our investment in the equities to companies that have less downside volatility.
Thank you. So I thought I heard we're at a high level right now. We're going to drop into the lower levels for Dan's comments would be more likely considered in regard to how we steer our funds. Right? That's right.
I think that levels have actually already come down. The 2022 experience was negative.
I didn't say that well. We're doing the big pie cut here.
Yeah.
Later, we'll go into the small pieces and determine if healthcare is a bigger piece of the equities and so forth. When will that occur for us? A month, 2 months, 6 months?
Good question. Probably in about a quarter. I would say in the next quarter.
Okay.
Doris, did you have a-
We don't have it set on the calendar, but we can bring it back within the next few months, certainly, to look at that division of how the equity allocation is split between segments of the equity market, international, small cap, and whether you want to do some sort of targeted fund. We could bring that back within a few months.
Yeah, and Dan, I appreciate your research, and I think that taking that and asking it to be looked at by our advisors as well makes a lot of sense. We come back and make a decision on it. To directly address the big pieces of the pie, I personally would like to see us increase our real estate holdings. If anything changes in this, I like the mix we're at, but I believe this is a forever fund. Real estate, depending on what you're in, and Dan and I and us have talked about targeting certain types of real estate markets, but I think that for the longest term is a really good place to be. So anyway, that's just for everybody. We change this allocation in the way, and your point is points more to real estate. Thank you. Yes, go ahead.
Since I've been on the board, my biggest concern has been the amount of risk in our portfolio. But I really couldn't see where we could make any changes. It was one of the reasons that I felt so strongly against private equity. Doesn't make a lot of sense in a risky portfolio to take on more risk for the potential of earning possibly 1% or more on the upside, but with a bigger downside. So I very much appreciate, and Greg's leading in with addressing the fact that you're not trying to push us toward private equity. However, as dull as fixed income is, we have a very relatively low investment in fixed income, and I have not yet, up until now, didn't see where we could increase fixed and still make our assumed rate of return. So I appreciate what you're doing by leading us through this step by step. The whole report I thought was excellent and clarified things to me. Thank you.
Yeah, I would respond to Dan actually by saying that fixed income is probably less risky than the healthcare segment. We're really talking about the split between equity and fixed income to your point. So going from 21 to 25% fixed income is going to do more for your portfolio volatility than sort of shifts around the equities, which, we can look at that in the structure study next quarter, in a couple quarters, but focusing on the equity to fixed income split is the bigger decision, in my opinion.
Gary, do you want to mention? Well, I can
You
mention.
can mention.
In some of our conversations as we were working on this study together internally, there's kind of the question of why couldn't you increase fixed income, Gary, to your point, a few years ago, why didn't that seem like an option? And I think the key thing that's changed that Gary alluded to earlier is really our expectation for fixed income. So where rates have gone means that our expectation going forward for the next 10 years is significantly higher than where we were sitting before rate rises last year.
Any other conversation at this point? Is there any other slides that you'd like to cover, Gary?
Sure. I'll just keep it pretty quickly. Our conclusion is that where you are today is still appropriate, in that you could move from a 21% fixed income up to 25% fixed income. I think that's a reasonable change, and that still needs to be a return target.
So would you address the issue of possibly doing 2% more in real estate and everything else? Ups and downs. I mean, that's just a general comment as an investment advisor. What's your gut on that? How's that?
We think that in terms of liquidity, we could support a slightly higher allocation to real estate and private real assets. I think that it's useful to compare yourself to peers as well. I was just showing that chart here. Your level of real assets, when you take into account both the core real estate and the infrastructure, I think is pretty close to average relative to your peers. So we're probably comfortable where you are right now. Adding 2% to private real assets probably honestly wouldn't move the needle too much in terms of the quantitative numbers I'm showing you. It might improve the numbers slightly.
One thing we'll see when we go to the quarterly performance report is you're actually a few percent overweight real assets as you stand. So given the illiquid nature of that asset category, you have a tolerance band in your investment policy statement around each asset class, and the one around real estate and infrastructure gives, I believe it's plus or minus 5%. So you may run a couple percent over the target at times, including now, even though that's not your actual target.
Vice Chair, is that percentage shift something you would like included in a future study to examine how it could impact?
If we're going to have other work, yeah, sure. I just, if we ever got to the point that we were spending, having to spend 50% of our nest egg, real estate's all that's left.
What is that song? Buy dirt.
Yeah, right, buy dirt. Anyway, but it's up to the whole person.
Mr. Revelis, do you have any thoughts regarding the fixed income ideas or real estate conversations we're having?
I think the only thing that I would add is there are other retirement systems that are very close to our target in terms of fixed income, being at 21%. So the one that comes to mind is Marin. They're around 22%. I think somewhere very close to that as of December. So there are other California systems that are in our range. I don't believe that it's necessary for us to lean more into fixed income. I think it was slide 17, maybe, sort of illustrated that. Oh, no. Slide 25. Uh, 24, sorry. There we go. There we go. You know, the changes from mixed 2 to 4 over a decade. Not a whole lot. And the 50th percentile is likely to be where we're going to land. I went back and reviewed the studies from 2010, 2019, 2013 versus our actual performances, and we're right in there, and that's sort of to be expected. We're going to land between the 25th and the 75th percentile.
I would like to point out to the board, although this isn't an immediate concern, but if we do move to like 100% funded or very close, you could see a rather dramatic tapering off of employer contributions because they're not going to be making payments on that unfunded liability. So at that point, as we get much closer to fully funded or go over fully funded, that's where you really have to consider your liquidity needs more because you would be pulling more out on a regular basis simply by virtue of having less cash coming in because you were better funded. So it is sort of a double-edged sword when you talk about your funded ratio because it can have a corresponding drawdown in your employer contributions coming into the plan. Because if we were 100% funded and the unfunded liability had been essentially paid off and erased, the employer would only be paying the normal cost component. The employee and employer contributions would be limited to the normal cost. I think it was nice to see that the analysis that Callan did reaffirmed what we talked about when we reviewed the Gabriel Roger Smith plan sustainability metrics and talked about our cash flow analysis and the maturity of the plan, that right now our drawdown of assets is sustainable because, again, we have sufficient employer contributions coming in. And we don't have an immediate concern of liquidity in this portfolio.
However, if, excuse me, Mr. Chairman, if less county taxpayer money was going to support the fund, we might get our roads fixed.
Yes, and ultimately, there is desire from the plan sponsors to, pay down and pay off that unfunded liability so they can free up their capital dollars for other county needs.
We've certainly given those recommendations to the board, and I think made it down on that as well to pay that off more expeditiously. So, and I'm sure we'll continue to analyze that if there's an opportunity.
We can certainly look at options, and the county has been very good in wanting to work with us to find ways to bring down unfunded liability. Even that meant a short-term increase in their contributions so we can reduce the amortization of that base layer. The county was certainly willing to consider those aspects because they do understand the long-term potential savings there by paying that off earlier. So I think today we are looking for a motion on one of these large, big picture models as far as the allocation between equities, fixed income, and our private real assets. So then we can come back certainly within the next quarter or so with perhaps a more detailed review of that allocation to equities and look at the components for international and emerging markets and small cap sector target funds, broad market equity allocations. And that would be the next step, in my opinion. You can correct me if I'm wrong. Yeah.
Go ahead.
Well, given that, I could get from Robert's or message or his memo and what we've heard from Callan today, I'm fine with private equity, being out. And, given the recommendations from Callan and the reduction of risk, I would move that we go with the mixed three. Second.
We have a motion and second for mixed three on the proposal. Any further trustee conversations regarding that?
I will say that I prefer the target rate that we currently have, with the idea that we may be looking at a more targeted investment program in the equities portion over the next few months. And I would be concerned of a lack of performance with mixed three over time.
Any other trustees like to comment on the motion? About public comment? Go ahead, trustee Jordy.
Yeah, I mean, I'm also going to vote no. I think we can reduce the downside through adjustments in our equity allocation.
So is there an alternative motion? Oh, I think, maybe I'm ahead of myself.
Yeah.
I'm sorry.
We have public comment regarding the motion.
There is no public comment at this time.
You would take a roll call vote, please, Ms. Sully.
Ms. Covison?
She's thinking.
Sorry, I don't know what I want to do in this particular situation. I mean, I'm going to abstain.
Okay. Mr. Hawkins?
I vote yes. It's moving 25%.
Ms. Cavanaugh?
I
Mr. Jordy?
No.
Ms. Smith? Aye. Mr. Cromer?
No.
Mr. Shoemaker?
No.
Ms. Harris?
Aye.
Well, we have 4 yes, 3 no, 1 abstain. So then the motion will pass.
Thank you. On to the next. As far as
You
other
don't see
matters,
those kind of votes very often in here.
as for other matters under item 3, is there anything else that Callan would like to cover regarding our quarterly investment performance report?
Yeah, I think we can do that pretty quickly this quarter. But we did distribute the regular quarterly performance report update.
You want the summary of the full report?
I am on the summary. Just to check in, can we spend about 5 or 10 minutes here, or what's the desire of the committee?
I think 5 to 10 would be appropriate, and then we will be handling one item out of order and potentially taking a break after that.
Okay. Great. So maybe we'll just get right into it. So Hannah's going to spend a minute on the capital markets, and then we'll jump right into performance for your quarter.
Hi, everyone. It's been a volatile market, very difficult market to take for the calendar year 2022. The fourth quarter did provide us some relief, and it was a bright spot in an otherwise dismal year for capital markets. Continued macroeconomic concerns of inflation, potential recession fears, and political issues all led to higher volatility. But on a positive note, and what we're discussing today is the fourth quarter. which provided a welcome rebound, spurred by signs that inflation is in fact moderating. On this slide, we're showing returns to the end of December, and unlike the previous 3 quarters, they are positive across the board for the quarter, with the exception of the lagged private equity and real estate returns. U.S. stock indices were up 67%. Energy, unsurprisingly, was the highest performing sector. Value stocks outperformed growth, and large cap stocks outperformed small. International equities had a very strong quarter, outperforming the U.S. The ESA index was up over 17%. Small caps up 13%, and emerging markets up almost 10%. Currency appreciation versus the U.S. dollar helped with the returns, and notably, China reversed its zero-COVID policy in December. Fixed income, Bloomberg Ag was 13% for the year. It was actually the Bloomberg Aggregate's worst year ever. The second worst year was in 1994 when the Ag was down 2.9%. For the fourth quarter, I did manage to produce a positive return just shy of 2%. And importantly, inflation continues to roll over in the quarter, down 0.2% as of yesterday's report.
All right, so flipping ahead to look at where your portfolio stood as of the end of December, page 13 here at the top captures the total asset value of the portfolio as of the end of the year, as well as the history over the last 15 years, how it's grown over the last 15 years. You can see the benefit of the positive returns in the final quarter of 2022 there at the very far right of that line chart. But we can also see the impact of the negative return of the 2022 calendar year from the high watermark as of the end of 21. Importantly, and as we discussed last quarter, the total portfolio is still ahead of where we were pretty significantly ahead of where we were pre-pandemic at the end of 2019. And that's, of course, net of benefit payments going out. Broad asset allocation is captured at the bottom of the slide. There was about $615 million in total in the portfolio as of the end of the quarter. And this actually shows the change in market value for the fiscal year to date, so for the last 2 quarters. Investment return has been slightly positive, about $4 million. We had 1 negative quarter in the fiscal year to date period and 1 positive quarter. So we'll see that return was just about flat, positive, maybe 50 basis points for the fiscal year to date so far. And then net new investment shows a negative $11 million. That's a bit of a point in time number. In January, another $6 million went into infrastructure. So there was a bit of rebalancing activity that happened on either end of these time periods that affects that a bit. On page 14, we have total asset allocation for the portfolio versus the target. Importantly, the total portfolio was in line with the target and the ranges as specified in the investment policy statement. But as I mentioned before, you are a bit overweight real estate, so about 3.5% overweight to real estate. That's because the rest of the portfolio has gone down. We saw negative returns from public equity and public fixed income. Real estate has lagged that. We do expect it to catch up. Again, that the current asset allocation is in line with the allowed ranges in the policy statement, but that's where you sit currently. Page 17 shows the detail and changes for the quarter, a bit more of the rebalancing activity that I mentioned. Ultimately, there should be another $6 million that you'll see in the January report that's part of this activity. And then page 18 shows returns for the total portfolio for the quarter and longer time periods ended December. It was a great quarter for the portfolio, up about 6.5%. And that's versus 5.8% for the strategic target for the benchmark. So a good quarter to cap a tough year. For the full calendar year, the portfolio was down about 12.9%. Longer term returns, all positive, and all have done well versus both the strategic target as well as other public defined benefit plans. One thing that stood out to me on this chart in the last year is that while the portfolio was down 12.9%, we still fared well versus that peer group of other public defined benefit plans. So with that long-term goal of reducing volatility in a down market, that actually really played out well for the portfolio in the last year. It's nice to see those results come through due to your strategic planning. Fiscal year return on page 19, 0.6% for the fiscal year to date. As I mentioned, one quarter down, one positive quarter. Leaves the portfolio slightly in positive territory for the first 2 quarters of fiscal year. I will skip ahead here just to close out comments on pages 24 and 25. We show performance as always for all of the asset category composites and underlying investment managers with which you implement the strategic allocation. On page 24, we show returns for the public U.S. equity asset class for all of those managers. And notably, all of those managers did very well in the final quarter of the year. It was a good quarter, many of them protected on the downside as well for the full year, and longer term returns remain in good standing, so no concerns there. Your small cap managers, I will point out, Prudential has outperformed in the recent time period, in the recent quarter and year in particular, while the growth manager AV did underperform. That's actually a reversal of what we've seen in previous years. So it's nice to see those managers continuing to be good complements to each other in the small cap allocation together. Mid cap managers did quite well in the recent period. And then the remaining managers captured on page 25, international equity had a good quarter, a challenged year. You can see the variation between your growth managers within the structure and the value managers. That's to be expected over time, but it was certainly a challenging year. Fixed income, Dodge & Cox and PIMCO continue to do well, continue to be good complements to each other, and together, those two managers have outperformed the Bloomberg aggregate over all time periods. And then your infrastructure and real estate managers have also done well versus their benchmarks and continue to be good diversification within the portfolio. Overall, no concerns at this time. And look forward to diving deeper into that in future quarters. Any questions on performance? We also included the January monthly report, which was another positive month, adding to gains for the fiscal year.
Any other conversations anyone has regarding the quarterly investment report or the monthly investment report? Seeing and hearing none, thank you, everyone, from Callan and Greg online. Any closing remarks, Greg?
Oh, no, thank you so much for taking the time. We do this asset allocation study periodically, and to the extent events change going forward, we can take a look again. I think Gary did a great job showing how you're on a path to succeed over the long run if we stay the course with contribution and investment policy. And I think the two choices you had between 3 and 4 are both good choices. They're more similar than different from each other, and you just had to pick one. And I think both put you in a position to succeed. And there are 3% differences between the two, right? So very more similar than different. So I appreciate you going through the thorough process and the diligent deliberation between it. And we'll be bringing back work for you to talk specifically about the equity structure and if we should be doing anything different in that category going forward.
Thank you, Greg. Thank you all.
Thank you all. Appreciate it.
Okay, thanks everyone. Bye-bye.
Thank you, Greg.
All right, at the request of Vice Chair Shoemaker, we're going to be going out of order and calling item number 8 on the agenda, discussion and possible action regarding the Executive Director Evaluation Form. Sorry for the curveball. Executive Director Rentschler, is there anything you'd like to present regarding that?
Thank you, Chair Cromer. The revised form provided by the committee was
provided for trustees' final review and adoption. Attached also was the policy, so you could compare the requirements in the executive director evaluation policy to the content on the form. And I will turn it over to Vice Chair Shoemaker, should he have any comments regarding that.
Jim's missing.
Yeah, Jim's missing again. So, we did obviously quite a bit of work. I think this format that you've got in front of you was an effort, mostly by Jim and staff, definitely on the putting it together visually and operationally. It's real nice. I think you guys have done a good job. We had interesting discussions around the numeric system, and and the verbiage around describing the 1, 2, 3, 4, 5. And I think that through all of this, if you look at what we've given you, it gives you a range of, to me, a more nuanced range. But the important part is the committee really stresses that everybody writes comments where they can write comments. And that each and every one of us will fit that. And comments can be negative, they can be corrective, they can be advisory, or even a wish list by that commissioner or trustee about the ED. But the process in the end is not dissimilar to what we've done before. You'll do the system. It'll get compiled by your chair and vice chair, and a composite evaluation will be brought back. And I know one of the big issues that came up during this process was for Doris was that there was a metric-based system as much as possible to hold up against the strategic plan, and everything else is done on the day-to-day. I don't think there's any way to ever get people's personal, subjective opinions and comments. There was a CEO, Mike Scale, that we had. He always used to say, "Where you stand depends on where you sit." And so everybody might have a different opinion at times, and there'll be room for that. But I think it's a pretty good system. I don't know that I can address particular questions closely enough before. But the process, Kathy led us. Kathy did a ton of hard work on this early.
Turned it over to Jim.
And the finale was Jim, and I was along the way taking pokes at it and adding things and exactly that. But we think it's pretty good. Trustee Smith.
I just want to say that the committee members, Richard and Jim and I, all agreed on the fact that this is such an important document to use for professional development. It's not something to take lightly and say, Doris is perfect, just check all the trees and everything's fine. And I've done many, many evaluations in my career, and that's what a lot of people do. And I think we need to use it in a way that helps Doris and helps the board. And so we just ask that everybody take it seriously. I mean, the middle one of meets expectations is not bad. That's great if we can meet performance expectations. So we should not look at that as grading our executive director down because we say she meets her expectations. So I just want everybody to take that into consideration when they fill this out. She meets hers and ours.
Yeah, to that comment, it's really true. I consider myself I say a tough evaluator because I don't tend to stray off of these expectations very far, very often. And then some people literally, another organization, fives all the way down with great job with comments.
It's easier that way.
It's easier that way. People don't want to hurt people's feelings or whatever. This is a professional evaluation. for the village organization manager.
Executive Director.
Thank you, Chair Cromer. I just wanted to express my appreciation at the committee for undertaking this project. I had spoken with former Chair Smith about this last year, and that the previous questions and format didn't necessarily include things that I actually had control over, and the goal was to start aligning those metrics in the evaluation with parts of our strategic plan and things that I actually have some sort of impact on.
Mhm.
So I greatly appreciate all the time and effort that the committee put in on this.
Go ahead.
I might add, when we talk about correlating this to the strategic plan, that you will find as you go through to fill this out, that you actually have to go back to the strategic plan and look at it. And the way the staff, I think Maddie was part of this, put it together, is that there is a link. And so right from the plan, you can go back and read exactly what the goal one objectives were, so that you, and what the target date was. So if you read an objective that says it's not to be completed till 23-24, then you'll know that if it didn't get done this year, that it wasn't supposed to get done this year. So there's the links right in the report, or right in the form, and there's also a way to mechanically or electronically select your rating there. If you click on the one in every box, it'll give you a range so you can select it. I think Steph did an excellent job, so thanks Maddie too, Judy, but thank you. I will.
Yeah.
She did a really good job. Yeah, it was great.
I do have one question about the formatting. I didn't test it for expanded comment. Like if you write a real long one, will the box would open up? Really?
The only thing we couldn't do was limit the number of characters.
Oh.
You couldn't limit it. That'll be good fiction on an evaluation.
Any other trustee conversations regarding item number 8 and the proposed changes to the evaluation form for our executive director?
I move adoption of the policies in the form.
We have a motion on the floor
I'll second if no one else will.
and a second. Thank you. Seeing no further conversation or discussion from trustees, do we have any public comment regarding this item?
There is no public comment.
Thank you. A roll call vote, please, Ms. Zeller.
Ms. Cubison,
Aye.
Mr. Hawkins,
Yes, to approve the evaluation.
Ms. Cavanagh,
Aye.
Mr. Dirty,
Aye.
Ms. Smith,
Aye.
Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris,
Aye.
approved.
Thank you, and thank you to all involved for the hard work. We do have a member of the public, and to be respectful of his time, I would like to call item number 4 before we take a break. That'd be discussion and possible action regarding approval of the COLA, cost of living adjustment, as of April 1st, 2023. Executive Director Rentschler.
The report from Siegel is provided in your packets. It indicates that inflation rounded down to the nearest 0.5% at 6%. And that would result in a 3% COLA, which is our maximum COLA under the provisions of the county employees retirement law, with 3% going to the COLA bank.
Thank you. Any trustee or board member conversation or discussion regarding item number 4? I know, looking at the report, this is the first time in almost 40 years we've had some holdover regarding our COLA, so it's an abnormal situation. If we can skip towards public comment, if you wouldn't mind identifying yourself, and you have up to 3 minutes to speak if you would like to.
Yeah, my name is John Almeida. I'm a retiree from Mendocino County. And I make a trip down here every year to thank you for the coal raises, because they're very important to us, especially this last year. It's unbelievable, the inflation rate. I was paying for half a tank of propane right at $700. It was crazy. Food prices are up there. Even though you don't see me, I watch your videos regularly. not every time, but pretty regularly. And I want to let you know that the retirees of this county depend on your work here and appreciate your work as fiduciaries, trustees to this retirement fund. We depend on this. I can remember my father worked in the logging industry and had to work until he died because he couldn't live on Social Security. I worked half of my life in the private sector, and all I had was Social Security, which I knew I wouldn't be able to live on. When I came here and I put in the best performance I could, I am still in the lower 40% of the amount of funding for pay scale amongst retirees. So it's there, and most people are retirees of this county are about the level on where I'm at. And we appreciate these COLA raises. We need these COLA raises. And we paid into them, of course. And we thank you for this.
Thank you, John.
Thank you.
Thank you. How nice.
I would entertain a motion from any trustee that would like to present one.
So moved.
Adopted as presented, I take it?
Yes.
Okay. Any further discussion? Needed?
Do we have a second?
Yeah. Yes. Richard, Vice Chair Shoemaker with our second. Do we have any other further public comment?
There is no public comment.
Thank you. If you would take a roll call vote, please.
Ms. Cutterton?
Aye.
Mr. Hawkins?
So yes to approve the cost of leave.
Ms. Kavanaugh?
Aye.
Mr. Girardi?
Yes.
Ms. Smith? Aye. Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris?
Aye.
Approved.
Thank you. I believe we will handle another item out of order. I don't know if we should take a break first.
If the board wants a break, we can take a short one. I would like then to move to item number 6, which is discussion of the IT master plan, because we do have the consultants standing by in the meeting. Then we can go back to our routine items.
I would like a short break if we're going to go to IT consulting.
Okay.
That's just me.
You wanna-
I need to
If
stand
we
up.
can return at 10 a.m., that'll be 10 minutes. Please be on time and we'll get started on item number 6 at that time. Return from break and back on record, I guess, for our Board of Retirement meeting for Mendocino County. We will be calling item number 6, discussion and possible action regarding the Information Technology Master Plan and involving Linnea Solutions. Executive Director Rentschler, would you like to introduce them?
Yes, thank you, Chair Cromer, members of the board. As part of our strategic plan, we had an IT master plan prepared. Linnea Solutions, who previously had consulted with them, Sarah, before we selected a vendor for our pension administration system back in the early 2010-12 timeframe, had done some previous work for us. They're here today to present a 5-year IT master plan. With us are Peter Dwar and Abigail, and I'm sorry, Abigail, I don't remember your last name. Oh, it's right there, McDonald. I'm told that Peter happens to be under the weather and he may be turning this over to Abigail, and I'll leave it to them. Hi.
Hi, good morning, and I apologize for my voice. I'm under the weather, as Doris mentioned, and so Abby is going to go through the deck that we prepared. I'm willing to jump in and answer questions and handle the end of the deck, but Abby wrote the report and is familiar with the work that we've done, so I'll go ahead and share my screen and ask Abby to present the report to the trustees. Could you guys see my screen?
Yes.
Yes, Peter.
Okay, Abby, if you'd like to step through the deck, and please interrupt us and ask any questions as you would like.
Sure, thank you, Peter. I guess I'll jump right into the objectives of the plan. And the plan is the objective, for the projects and the initiative is a span over 3 to 5 years. And in particular, what we were looking at was increasing the functionality of Pension Goal, Member Direct, and the document management system that is COFAX. The sequence of activities to improve utilization and automation of MSERS systems, a review of current infrastructure and system, the current level of integration and IT policies, a strategy and an approach to implementing projects and initiatives. And this is essentially reflected in the development of a roadmap that highlights the future state goals and milestone timeframes. And Peter will go through that at a high level when we get to that section of the deck, as well as recommendations on cost, resource, and risk mitigation. And if we could go to the next slide, Peter. And so the report is structured as follows: a review of the current state of operations. At a high level, I can say that we believe that there's some opportunity to improve the efficiency of the way that MSER delivers services, as we'll go through some of the manual processes that staff currently are required to do as a result of some limitations with the current version of Pension Goal. We looked at the high-level cybersecurity assessment of 9 security controls from the National Institute of Standards and Technology to determine the effectiveness of current security controls leveraged to protect member data, future state vision and goals, and this includes reduction of processing time and reliable performance metrics. And again, the development of a roadmap and project timeline, estimated budget, recommended next steps. These are areas that Peter will cover. Thanks, Peter. And the next couple of slides will go through. Okay, thank you. So the next couple of slides included, So the next couple of slides, we will review the current state of operations, Pension Goal, data review, IT infrastructure, manual processes, and the cybersecurity assessment. Thanks, Peter. And for Pension Goal, we noted some gaps in the employee reporting of service and contribution information.
Hey, Abby, could I interrupt you for a second to make sure that the trustees understand pension goal? I know
Yeah.
we're familiar with the pension administration system that's currently in use, but I didn't know how much you know about that system and if you're familiar with it. I'm sure some of you have approved the budget to implement that system, but I just wanted to check.
Minimal.
No, okay, so good. So
And it ain't cheap.
well, for those that are not familiar with the system, this is the main IT system that is in use by MSERA currently. And as was just said, it's not cheap. And so you spent millions of dollars implementing this system. And so this was a major portion of our examination. And this system, as the administrator could tell you, that that is used by most of your staff and occupies a lot of their time. And so what we're seeing here is that there are places that could be improved, but this is a significant investment on your part. And so it bears serious, consideration as to what could be done to make it better. Sorry, Abby.
No, thank you so much. That was important. So yes, Peter mentioned we did identify some gaps that we believe is worth improving, sorry. The way that, for example, enrollment of new members on the self-service portal, that is the credentialing process and the use of pins to validation. And we'll go through that as part of the cybersecurity assessment. For account audit, I'm sorry, did someone have a question?
There's a question regarding the PIN. I think it's a personal identification number, just as like a debit card or credit card would have. Is that correct, Abby?
Correct.
Thank you.
You can continue, thank you.
Sure. And for account auditing, and Peter, maybe you could jump in here, but I think with regard to this one here, we noted that there's a need for additional verification of whether Pension Goal had the capability to perform auditing of access to a member's account.
And that's correct.
Correct. Additionally, we noted that there's currently no chat feature for members to communicate with MSERA staff or to set up scheduling. So that's a gap that we identified. Also, not leveraging electronic signatures, and Public Employees Pension Reform Act members are subject to a salary cap. They cannot run an estimate of their retirement payment.
And so with the PEPRA staff, that are employees that are subject to PEPRA, which means that there's a limit on their pension contribution after a certain amount, that process has to be handled manually because the system, one, doesn't accommodate it automatically, and the county systems don't automatically account for that too. So there's a manual process on the county side and a corresponding manual process on MSERA's side. And Doris, you could correct me if I'm wrong, but
well, we did make a little bit of progress on the county side. So we are addressing that, but you're right, there are still limitations on Pension Gold that require manual processes for our staff. And we will be looking at options there, but we made some progress on the employer side. I don't know if I've given you that update, so.
You did, but this was a finding during our examination, but as you'll see with many of our findings, the staff have been continuing to make improvements to the process as they go along.
And for the data review, these are pretty self-explanatory. The transmittal file is not correctly picking up address changes from the county financial system, Munis. There was a incorrect refund classification at the point of data conversion as well that needs to be addressed. Also, for the actuarial process, it's limited in its ability to aggregate all the necessary data for the actuarial submission process as well. So that's something that needs to be addressed. Leave without pay is not posted to the system, affecting the final average pay. There are manual transactions not reflected on the general ledger export, including child survivor benefits. And the existing Colfax module for document management is not configured to perform advanced recognition of forms submitted. So those are some of what we found as part of data review. Any questions? Peter? And for the IT architecture, current state observations, very simply that architecture is provided as by the county IT department, including network connectivity for pension goal through the cloud. The county also provides disaster recovery services to ensure that MSERA is able to regain access and functionality in the event of a disaster. Pension Gold pension administration system is hosted and managed by, hopefully, Levi Ray and Shoup Incorporation, and member direct self-service application hosting is integrating with Pension Gold functions as a self-service portal for the users.
Yeah,
Anything?
if I could just summarize that. So most of your internal systems, like those that you're using right now for this meeting at the office, are managed and supported by Mendocino County. But your major investment sits in the cloud, hosted by LRS in Illinois, right? And so the county provides connectivity to them. And if something was to happen at that primary site, they fail over to a redundant site in Sterling, Virginia, not too far from where I sit. So you do have a major cloud presence that you may not be aware of, and is supported by LRS, that you significantly invested in standing up this system and supporting its continued use.
Okay, next slide. And so for the manual processes that I mentioned earlier, we documented some of them. Service purchase calculations, labor intensive and spreadsheet driven. The investment activity journal entry process is labor intensive and requires spreadsheet manipulation as well. Death claim payments require exports from pension goal and manual intervention. These are just some of the pain points. Employee reserve balance. Yeah, I don't know that I need to.
Right. The point is here is that there are many manual processes that are ongoing right now. And so as you'll see in our recommendations is to try to reduce the manual processes right now that staff have to go through to get the job done. And so this is an effect of some decisions that were made when the system was being implemented maybe 5 to 8 years ago. And so there might be an opportunity in the near future to address some of these deficiencies. Okay. So if we could continue, Abby.
Question, Vice Chair.
So, have you prioritized these deficiencies? Have we prioritized these deficiencies?
In part, and I'm sorry, Peter, did you want to go ahead?
No, please, Doris, please go ahead.
We are looking at prioritization of certain deficiencies and activity, but part of that will come from the recommendations of a steering committee, which is part of what the plan suggests, is developing a steering committee to help focus how we're going to address some of the pain points, as Peter refers to them, and the potential plan as far as implementing it. So I don't want to go into significant detail right now,
Right.
And I'll turn it back over to Peter.
Thank you.
Yeah, and we do get to that. So these are just some of the evaluation processes that we went through before we get to our recommendations. Could you continue, Abby?
Sure. So for the cybersecurity assessment area, we've reviewed really at a high level. Again, those 9 NIST-based controls that I mentioned earlier: access control, awareness and training, configuration management. You can see the others: contingency planning, identification and authentication, system and communication, physical and environmental, and security assessment. We did find, again, as I mentioned earlier, we did find some opportunities to improve credentialing.
And we would not go into details about cybersecurity deficiencies in an open forum, but we would happy to share those with the trustees in a closed forum. But as a matter of practice, we wouldn't want to go into cybersecurity vulnerabilities in detail in this forum, if you understand. So that's why we just put this out as a high level of what we've examined. But Doris and staff have the detailed report. Sorry, Abby, to interrupt.
No, that's okay. Again, good point. And I guess we could go to the next slide, and Peter, you could run through these.
Sure. So we recommend, a future state that would certainly increase productivity and try to improve services to members, especially through the self-service portal, and try to reduce time when it comes to processing retirements and so forth. And again, of course, the manual processing, I think, is a huge issue. So as was asked before, this is the list of selected new functionality that we recommend that MSERA, considers, such as finding ways to automate some of the manual processing, especially when it comes to, say, document handling, and automating as much as possible what we call straight through processing, meaning that processes that we know follow on, and we could have the system perform the functionality with stage gates for staff to review, so that the staff functionality now is managing rather than performing manual processes, and address some issues with, beneficiary, payments. Of course, improving the member direct. Member direct is the member self-service portal that members would go to log in and either get a 1099 if you're an annuitant, or see your contributions if you're an active member. And so improve the ability to, correspond and interact with MSERA without necessarily having to call or come into the office. And fixed some issues where the calculation of when someone wants to purchase service, there are issues there. And there's an issue with employer balance tracking when at the time of conversion, balances were not existing employer balances were not imported properly into the system. So when someone retires now, they see the employer, they're calculating a full employer balance rather than a contribution that was made up until the system went live, if that makes sense. So it's overestimating the employer balance. And Doris, did you want to jump in on that to see if we get that right?
Sort of close enough. We do have an issue we are addressing with LRS regarding the general ledger retirement reserve transfers because there was an over transfer from the employer reserves to the retiree reserve, and we are working on ways to address that with LRS.
Yeah, before I go on, did we answer the previous question about what are the things that should be addressed on a going forward basis?
I think that slide summed it up nicely. Yeah.
Okay. One of the things we recommend to the board, if you do decide to adopt an IT plan for 5 years, is that you have the appropriate governance in place to manage that undertaking. You have a small, an organization that's with staff of a small size, and they have regular ongoing duties to perform. So if they were to undertake implementing a 5-year IT plan, then without the appropriate governance and support, that we think that they may not be as successful as there could be. And so one of the ways to be more successful is to have a steering committee in place and to have the appropriate subject matter expertise available, but to engage a consultant to help define the requirements of what you want to achieve and also to help you implement the solutions. I think a key partner would be the county because they provide so many services to MSERA, but also LRS, who manages Pension Goal, which is your major investment in information technology. Does that make sense? And are there any questions on that?
So Peter, regarding your steering committee, you're talking about a representative from the county, LRS, and then staff members or trustees or recommendation?
Yeah, well, it would be staff and potentially a consultant. It would be good if there was trustee representatives on the steering committee so that you would have insight and visibility into the workings of the committee. But certainly, it would be regular reporting out to the board, the trustees, regularly on where the plan is going and what tasks are recommended to be undertaken first, right? So, because there would be a budget component of trying to get things done, and the steering committee would have to come to the board for approval.
And I don't think the county or LRS need to sit on the steering committee. If that was one of the questions, that would really be, trustee staff, maybe a consultant. But certainly we would be engaging with the county and LRS because they do provide us with our infrastructure and our primary application in areas where whatever project touches on those areas of responsibility.
So it looks like on the low end of the estimated budget, I know it's just an estimated, we're looking at approximately $850,000, and it's going up exponentially from there. I know that all those projects would not be running at the same exact time, and those expenses would come up at different times, but that's my main concern as I sit here. I think that a steering committee would be appropriate to even triage or prioritize those items in importance and present them back to the board as their, top 3 or 4 priorities to spend that money on immediately. Mr. Revelis, do you have any comment regarding the estimated budget on this?
I don't.
Is it you would like to be on or included in the steering committee as a part of the budget oversight?
Yeah.
Okay. Not to volunteer, put you on the spot, sorry.
And if I could make a comment, Chair, regarding these estimated budget numbers, you can see they're very broad estimates of what something may run, because there are a lot of items to take into consideration when we talk about a pension gold upgrade or adding workflow capacity. So these are just very rough numbers. I don't want to tell the board that we're committing to a specific budget or anything for that. And as projects are prioritized and we decide to work on something, we would bring back a project-specific budget to go with the specific work being done at any point in time.
Go ahead.
Right.
I'm looking at the strategic plan, and our goal 3, objective B says align technology advancements to evolving business needs and complete a technology roadmap. Is this encompassing everything we wanted to do there?
I believe it is. Certainly at the past meetings, there had been comments, certainly at the strategic planning meeting, about a review of where we rely on the county for services, IT being the largest part of that. And Linea's staff did look at the services we receive from the county as far as the IT infrastructure, and basically has concluded that it makes sense for us to stay with the county given the packages of services we're receiving and the cost. Due to trying to piecemeal, you might end up with a slightly better cost, but it takes a lot more time of staff to manage those vendors and contracts, and that we have a good bundled approach right now through the county, and they're not recommending a change to that, so to speak. So we have looked at areas to see where we could make improvements, and some of those will include technology aspects, whether it's how we handle our electronic documents and use of electronic signature. And those are some of the priorities that could be prioritized by the steering committee to decide where it is most appropriate for us to make those changes, and based on our goals and the dollars we're willing to spend. And if I didn't sum that up well, Peter, feel free to jump in and add anything that you want.
No, you did a great job, Doris. Welcome to the team. But yeah, this lays out over a 5-year period potential projects that you could undertake, right? And as Doris mentioned, those are just very, very high level budgetary numbers. We would go to individual vendors to get specific quotes on requirements that, the steering committee would work on developing in detail so you could get accurate quotes. So that's why we didn't put a total at the bottom, because we don't know that that's what it's going to really cost, over the next 5 years to do these things. But to give you an idea of potential costs, we thought it was prudent to put the range of numbers in there.
Thank you, Trustee.
Peter, as a consultant, as a potential consultant in this process, what would the job be of your company? What would you be doing to help us?
So similar to what we've done before, is that we would, meet with the steering committee and look at your goals and the pain points that you have, and come up with a plan, a short-term, a medium-term, and a long-term plan to address those pain points. For example, the most immediate needs, as Doris would articulate, that that causes the most disruption in providing services to members. We would, especially if they're short duration projects, we would look to define the requirements to solve those problems and try to figure out when those could be addressed in the near term. Like, for example, there are some projects that take longer. Like, we spoke to the vendor, Doris spoke to LRS and received the feedback information about, say, upgrading to the next version of the software so that you could take advantage of some improvements. But they're not offering that to you until, I believe, 2026 or further on, right? And so that would be slated to be done later, and maybe improvements to the current version that you're on would be slated to be done now. But since we work with all of the vendors in the industry, we work with over 80 funds. We understand some of the best practices that could provide relief and produce services to your members. And we would have those discussions with the steering committee, and then and work with them to decide which ones to take on first and to bring to the board for approval.
And if I might jump in, Peter, I think the consultant could certainly help us with identifying the business need and the technological solutions to it, and defining how we approach that project as far as the requirements, helping us define those requirements that we need to make sure we get a solution that actually serves us. Because our staff doesn't really have that IT technical expertise, and that's what the consultant would be bringing, would be helping us take what we know our needs are, but putting it in terms that a software vendor or equipment to help us obtain those. They bring the technical expertise.
Right, and we exactly, and we would work as your advocate with the software vendor, because we would work to understand your business needs, and we understand how they deliver software, and so we represent your interests in regards to them.
Thank you.
Well, in an effort to keep on track with our timeline here today, I know we have a couple of trustees that are going to have to excuse themselves in a pretty short amount of time. Is there anything else that you would like to go over, Peter, to sum this up?
Yeah, just one last slide that with some recommended next steps. If you decide to go in the direction of implementing the plan and implementing the steering committee and so forth, these are some of the steps that we recommend that you take. And we've talked about some of these, about getting detailed costs and so forth, developing a detailed plan, and developing a budget, and of course, continue communication with the trustees.
So I don't think this is necessarily an action item. It's more informational, but certainly at some point we would be wanting to move into development of a steering committee, but that's nothing that has to be done today. This was essentially receive and file. I don't think it requires any action.
Okay, are there any other trustee comments that anyone has, would like to provide, questions?
Awfully expensive.
That's why I question. When we looked at the strategic plan and talked about whether we could do it with or without a consultant, the two benefits of hiring a consultant is what you just mentioned, the technical expertise, and also the saving of staff time, somebody else to do the work.
And these broad estimates some of them were just very roughly ballparked and thrown out there. It might not be that expensive to actually upgrade to version 4 of Pension Gold, but it might be. It's almost the equivalent of getting a new system because of some of the significant modifications they've changed. So it's not like a minor little upgrade, it would be a significant version change. But PG says, you know what, we have no plans to discontinue supporting any of our existing legacy products, so we will support your use of version 3 as long as you want to continue with it. Because we didn't implement workflows as an example when we did the initial PG implementation, LRS has said that it's probably not going to be cost effective for us to look at implementing workflows in our existing PG product. But that is something that could be done if we ever did a full upgrade to their next version. So we have to weigh the importance of some of those things. Is it important for us to have workflows, or would we, rather focus on other areas that we could implement and still integrate within PG without necessarily doing the upgrade? But at some point, we may want to upgrade to the next version. That's really where the steering committee takes information and feedback from us and our vendors and makes those decisions.
But it's not available yet.
They are rolling it out to new clients. They have not offered it to existing people on any of their Pension Gold platforms. And they said it would be 1 to 2 years before they even offered it to existing clients. And I would not want to be the first existing client to move over.
It's a data transfer issue. Oh, yeah. So a related question, are you aware of any of the specifics of version 4? Because I know we have had previous conversations regarding the bifurcation of benefits. If the board wished to move that direction, that included a significant amount of programming to the current system to achieve that. Would that be an option under 4, or would it have to be additional programming?
Well, let me start with the existing version we have can accommodate the split account or separate account, bifurcated accounts, divorce methodology. The Pension Gold estimate to essentially activate that module was about $30,000. So I would consider that expensive, but not horribly expensive. I was actually surprised it came in that low to add that. It is because their base product has that functionality built in. It's just it wasn't customized and programmed when we did it. They would be going back and doing that now. But it's certainly much more cost effective when you compare it to adding workflows, because workflows touch so many different aspects. It was going to be $500,000 to add workflows to the current PG version, but it's only $30,000 to add the separate accounts for divorces. So we would look at all those items, and we'll be bringing back something about the split accounts in April for the board's review.
Very good.
Sorry, off topic there, but
Yeah. I know it was somewhat related. Trustee here.
Just one question. What I zero in on immediately is Pension Gold System Security Plan. And my question being, isn't there one already?
Certainly. And there was, I believe that broad topic talks about our desire where we'll be doing the member direct upgrade and going to 2-factor authentication for member login. It was also looking at maybe our password structure here for staff access and a variety of little things that we can look at. PG has their own cybersecurity network, to secure the data and their product. We get their SOC reports annually as a review to make sure that they've been looking at things they should. And we have a business continuity plan both for ourselves and with Pension Gold, part of which is called PG Secure, which would allow us to actually have them run certain business processes for us, including benefit payments. If something happened here and, there was a big earthquake and we couldn't access anything, because telephone lines are down, we don't have internet, we can't get on to do the business process, we have a way that we can authorize PG to do certain functions for us over a limited period of time to continue critical business operations. So we have a variety of cybersecurity and computer security pieces there. This is just, of course, reviews those and says, these are things you might want to look at adding like two-factor authentication on member direct to enhance the security.
Thank you.
So with regards to item 6, is discussion and possible action. I'm not hearing any proposed motions. I understand that there's been some limited direction given to staff, and we can finally receive this report and the presentation. Thank you very much, both Peter and Abby. We appreciate your time. Are there any further directions that trustees would like to give to staff regarding this item?
I
Go ahead.
would, maybe ask who might be best of the board trustees to serve on a standing committee like this. And does anybody want to volunteer? And I'm not volunteering.
You're asking and not volunteering.
Maybe the person who raises.
I don't think I have the expertise.
Are there any trustees that,
We can certainly bring that back next month.
okay. We'll think about it over the next month, and if anyone has interest, please bring that interest to our next meeting, so we'll know. Otherwise, I think that handles item number 6. We'll receive and file the report and the presentation. Thank you very much.
Thank you,
Thank
Peter.
you.
Thank you.
Thank you.
Take care. Be safe.
Okay, bye.
Moving backwards again, number 5. Item number 5 would be the quarterly budget update, Mr. Rebels.
Trustees, you have the quarterly budget update. I'd be happy to answer any questions you may have. I don't believe there's any surprises.
Yeah, we're pretty much in line with expectations everywhere, aren't we?
Yes, that's correct.
Well, again, I don't see anything as far as action needed on this, so we can accept and receive your report and your very detailed memorandum. I appreciate it. Any other trustee comments? I'm just realizing now I forgot to ask on public comment for the last IT matter, but I'm not seeing anyone. So, any trustee comments on this item? Any public comment on this item?
There is no public comment.
Okay. Thank you, Robert. We appreciate your time on that matter. That brings us to item number 7, discussion and possible action regarding alternative locations for Board of Retirement meetings. Executive Director Runchel.
Thank you, Chair Cromer, members of the board. I provided a summary of different locations that might be available to us if there is a desire for us to move to an alternate facility that might allow for a larger meeting room to facilitate better airflow and maybe social distancing. There are no super great options here, but I tried to provide a overview of the advantages or potential disadvantages of the different sites. If you have any specific questions, I'm happy to address any specific questions. I would be looking at board direction on whether or not you want to move to an alternate location, starting with the March meeting, because starting with March, the AB 361 exception to allow the teleconferencing meetings expires, and we would expect all board members to be back in person unless they follow one of the other provisions under the Brown Act. To me, it looked like the best option might be use of the Board of Supervisors chamber over on Low Gap. They do charge for that facility. It is $75 an hour with a 2-hour minimum. So you're talking about $150 minimum for each meeting that we would have there. They do not allow any type of food or drink in there other than water. So I just wanted to mention that. But it is a larger room. It does have some dedicated public seating and makes it a little easier for in-person public comment. We still would broadcast live and allow public comment via phone or web access if we went that route, because we would expect that we would probably continue these meetings on Zoom just to allow for public comment, even if all the trustees were back in person. Any questions or?
Trustee Smith.
Sorry, I have a lot to say this morning.
I enjoy it. Go ahead.
The Board of Supervisors Chamber, one of the things that, was discussed was the area, the limited number of microphones, I guess, up on the dais. And we don't need to be up there, if we're, in a room, but I think the concern is having microphones, right?
Part of my concern is that we do not have very good audio when we try to do the webinar meetings. Having been on the webinar end of it, it was very difficult to hear what folks in this room are saying. So I don't see it as really beneficial to the public to offer a webinar where they can make public comment if they can't understand what the people in this room are saying.
Okay.
The Board of Supervisors Chambers has a microphone at each station, and the entire board, although there's only 5 Board of Supervisors, they have other staff areas that each also have individual microphones. All of the Board of Trustees here could have a microphone, an individual microphone if we were using the board chamber.
And why do they charge a county affiliated organization to use their room?
You would need to ask the executive office, but that was recently adopted and implemented effective with February, if I'm not mistaken. They had started looking at that back, I think, right before the pandemic hit. But they do have a policy. They don't allow non-governmental agencies, I think, to use that room. It has to be something like with a public purpose. If I'm not mistaken, in use of their meeting room, because it's always open to all members of the public. So they do charge. Also, if we ever considered going up to the Behavioral Health Regional Training Center in Redwood Valley, they also charge, but they have a lower rate. It's $75 for a half day for a government agency. They charge more for non-governmental agencies. Some of the other meeting rooms don't have any charge, but they do have some limitations as far as equipment or size or availability.
The Farm Advisor Conference Room just doesn't have any equipment, and it is what the comment there is.
She said they have like a television or a monitor, and that's basically it. You would need to bring your own computer to hook up to it, your own meeting owl, or microphones, etc. Because there isn't anything as far as audio visual equipment there other than a TV.
Having spent 17 weeks in the Farm Advisors Conference Room, taking the coursework to become a master's gardener, it's not a bad room.
Right. But it doesn't have any built-in AV technologies. They don't have any built-in cameras or microphones. We would need to bring that equipment and set it up with us for the meeting.
It's a very large room, and I had meetings there as well. And I was of the option, very interested in option number 4 with the Farm Advisory Conference Room, but there's no IT setup.
Yeah.
But
and we could either bring the equipment ourselves or work with county IT to have them come in and help us set up the equipment. Again, it would likely be just using a meeting owl. And so you would be limited to the one microphone in the meeting owl unless we found additional ways to hook up additional microphones, which currently is not supported, is my understanding. So we do have some technology issues we would need to iron out if we move to that facility or really at most of the facilities.
What, somewhere in here, I couldn't find it just now, it was discussed bringing microphones into this room. Is
Yes.
that easy to do?
We've reached out to IT and had them come out and survey what we currently have. They did say our equipment is on the old side, especially the cameras. They gave us 3 quotes, which ranged from, and I have a little bit more information, I think, in the administrative report on cost.
That's where I saw it.
Absolutely low end, which was borrowing some of the equipment from IT for every meeting, was probably about $5 grand. Otherwise, you're looking at 10 to 15 grand for the equipment that they're recommending, which did typically include additional microphones. One of the estimates from IT was just utilizing the 2 microphones on the ceiling that we cannot currently do given the box we have and it's the webinar meeting that's causing a problem with not being able to use some of the existing functionality. we could go back to the old version, which was still a live broadcast, but not permit web.
It was not
It was not live, sorry, which was recorded and posted later and just have in-person public comment. I thought the board's desire was to continue the web meetings to facilitate public comment for people who don't want to come down in person because it's a little bit easier. And that's where our technological issues remain right now as far as trying to look for solutions for that.
Well, I personally, think it's wise to continue allowing public comment over web. And I saw that, Dan was, requesting to go through the Brown Act requirements to have a solution perhaps in, Fort Bragg, which is great. And maybe sometimes Richard would be there.
And I can include that in this memo. I do have some information on that if you'd like.
Okay, it was somewhere. I read this somewhere. And, I mean, when you talk about ease, you know, carting all equipment and everything doesn't sound easy to me to set up in one of those other rooms. I have no problems with this room, especially if a member or two are going to be in another room. I mean, I don't know why we need to move.
I believe this item was brought to the board because of a few trustees wanting an area that had an opportunity for more social distancing. Because this room does not offer that. I know that there's many people here today, but we are within feet of each other. And I think that's why this item was brought. Yeah.
I think that was why it was brought up too, but that is not a great concern to me. Yeah.
Understood. Any other trustee conversation regarding this item or input or direction?
A comment, I can recall 1997, this exact same discussion. Not here,
Yeah.
but with the county
Yeah.
about getting this out to the public and streaming and so forth. At one point, the league, CSAC put together a program and actually put the equipment out into the county. There was stuff set up in a conference room and stuff that we were on. But anyway, here we are again. I think that the expenditures to upgrade this room will be worthwhile. For access for people who live in Louisville, that may want to participate in watching, even if it's only one person every couple months. For them to have to come here or hear it late, it's worth it.
Really a point of clarification on accuracy. Perhaps it'd be wise to re-poll all the members to see who objects anyway in this room, because their opinions on the subject might change.
Well, I'm just looking for board direction, so that could include getting a current feel from trustees on their opinion.
And my personal question is, if anyone is looking into upgrading the HVAC system here in the room to further support better ventilation, that's one reason addressing this concern. We have not priced upgrading the HVAC system to look at improving airflow or anything in this space. I would need to do more research on that and get back to you if that's something the board wishes to look into. I just wondered how accurate the previous poll was taken on concerns. I don't know if it was a full poll. We just had a couple of comments with some direction to look into options.
We have some comments pending. So trustee Covison and then trustee Jury, go ahead.
Thank you. I know this might sound like a strange question, but I just wondered if there was possibly additional seating options at the current location. I understand that that means obviously that I will be needing to come over there rather than, coming in from Zoom. But I just wondered, even if we're in the same physical building location and I'm in it, or somebody who maybe wants more social distancing, if they were in a other physical office and still able to Zoom, would that still meet with the requirements in terms of, it's not really a different location? Maybe it wouldn't. I'm just suggesting if somebody was not comfortable being in the room for some reason.
Refer that one to council for an answer, because I'm not sure exactly what the requirements of the Brown Act are when it talks about, being together.
So I think that's an interesting question, and I say that because the key piece is to include the address on the agenda and make that accessible to the public. And but the other piece of it is that I've kind of read maybe in the legislative history of some of the amendments is to make sure that there's nobody there in that room influencing you. So if most of us were in the conference room, but somebody was in an office with the door closed in the same address, I mean, it maybe raises some questions. I'm not overly concerned about it, but I think it'd be better if we were all in the same room, or, you know, it's just to avoid even the appearance of that event.
To that comment, I could say, you know, staff could potentially go back to their office and there would free up the space at the table.
Yes.
There's nothing by law that says I have to be here. I don't vote. I'm not subject to influence.
That's true.
But we
So
wanna
these
see
might
your-
be options that we can look at that.
I want to see your.
We
facial
want to see,
expressions.
yeah.
Okay.
Yeah.
But similar to Robert, rather than come in and take up a chair here, since he's staff, he just calls in from his office 2 doors down from here.
Norris and I could both
Yeah.
Zoom in from our office, and that frees up.
Give a little more space to the folks who participate here.
Trustee Jurdy.
I would be open to that, but you know, the audio is not fantastic from the owl, and so I can generally hear what everybody's saying, but there are moments, for example, just a little bit ago, Richard said a few words that I didn't pick up on, and I'm wearing earbuds.
You're not the first.
So I think the simplest option, even though it's $75 an hour, perhaps that could be waived. But the board chamber rooms is already set up for this. It just seems like that's the simplest option. It would take the least amount of staff time to set up for each meeting. We have good audio in the room. There's plenty of social distancing. Not only are there the 5 supervisor stations, there's 2 where typically that's the chief executive officer and the county council. Then there's another table out at the same level for 3 additional staff people. That's 8. Then you've got in the clerks section, you've got room for 1 or 2 more, plus so now you're talking 10, 11.
Essentially, like 12 people up in the, let's call it the whole dais area, not on the dais itself where the 5 super, but with the rest of those staffing areas you mentioned. I think there's 12 stations, maybe 13 if you use the portable one.
Exactly, all with their own microphone.
The seats are not necessarily social distance. They are spread out a little bit, but there's a group of 2, a group of 3, a group of 5. Even the 5 chairs for the board of supervisors are not technically socially distant.
Exactly, but they all do have their own microphones and people are spread out much more. So I think it's really the simplest option for setting up and taking down for each meeting. The one issue to be attended to is the fact that apparently on the 3 days where we have afternoon closed sessions, there are 3 of those meetings throughout the year. They're asking for us to clear out by 11:30, but that maybe is just some management of the agenda trying to load up a little less on those 3 meetings of the year.
That was my concern as well, Trustee Jurdy, is just to be cognizant of those dates where we would have a firm cutoff time. And not that we regularly go over that time. You've been on this board longer than I have, but it's happened. Go ahead.
And maybe if there was one meeting where we just had some significant business, it was going to take longer, maybe that one meeting we schedule over at the Ag Commissioners conference room and have a little extra setup required for that one meeting. But I just think the simplicity of the board chambers, 99% of the time, it's the better option just because the setup is simpler.
And that 11:30 cutoff is, I say it's a hard cutoff. It's their preferred cutoff. I think if it was critical, we could push that to close to noon. But they do need to go in and get it set up, of course, for their meeting that would be starting at like 1, and their folks would do that setup over lunch. But trying to be considerate of their staff time to get that meeting room ready. 11:30 would be the preferred cutoff time.
Any other trustee discussion, comment, thoughts I know we've lost Vice Chair Shoemaker for an appointment, and
I'm out of here
Trustee
in
Harris is leaving
10
shortly.
minutes, yeah.
I would like two pieces of direction. One, where you would like to meet, and get a vote or board direction on that, rather, I guess it doesn't need to be a motion, but a vote. Or rather just direction, not a vote. And also, and then we can come back to this, whether or not we want to, research further and upgrade the audio visual in this office.
Go ahead.
I can think of two other places that haven't been mentioned previously.
What?
Well, two that I think of is the Ukiah Convention Center.
We already discounted that based on cost and again, our ability to take in the equipment and have to do that setup.
That might also apply. Take your friend road up towards the casino here, casino. There's a tribal health.
I did not check that.
It's very nice setup. I think there, quite large.
I've had a meeting there, and there's windows and doors that can be opened. It's a big building. It's probably larger than the ag.
I'm not sure who the agency is. I'll have to track that down.
I just thought of something. If you do change the location of the meeting, I just checked the bylaws. And the bylaw says that they'll be at our office. So it's just another
We would need to
hurdle
update
to
the
jump
bylaw.
through.
And then, of course, if we do want to move, do we want to try for March? Do you want to update the bylaws next month and do something else in March? Go ahead and meet here and move in a future month. Yes, I'm sorry.
Two things. Can we put in windows that open? Is that against the law?
We can look at that. We don't have a price for that, but we can certainly look. There is a window that's operable in my office. But we could look at replacing these windows with operational ones to allow airflow, open up the windows.
I think that would be less.
It might create some noise issues in some instances, but,
And my second comment is, given, what Dan said and what some of the other folks have talked about, I don't, if the Board of Soups is set up and all we really need to take over your computers and that's it, then why don't we just try it? Not say we're moving, just say, let's try it.
well, we have to probably update the bylaws before we use that site because our bylaws say we meet here. I think that's what you brought up, right?
One
Yeah.
exception to that.
There's a clarification, Jeff. We're looking at the regulations of the board that were adopted August 17th, 2022. It does say that they should be held here at this office or such other place and
Yes,
time
thank
as
you.
the board may from time to time designate.
Okay.
Thank you.
So you're correct.
Good catch.
Thank you, Ms. Zeller. Anyone have any further discussion? Let's just keep it to one item right now about the Board of Supervisors chambers. Does anyone have any heartache regarding the cost?
No,
I
I think
think
we
it's
should
minimal.
ask, yeah, to get it waived.
So to pursue, if I can synopsize, pursue that location potentially for the March meeting, post that as an exception to our regulations, and then bring an item next meeting to potentially assess and change the bylaws.
Actually, we don't need to.
Since it has that other language.
Okay.
Yeah,
Okay,
because you may decide I think this gives you enough flexibility.
okay,
And certainly if, let's say Richard and Dan choose to remote in from a conference room over on the coast or something, then maybe, upgrading the equipment here and returning to meeting here would be sufficient. But we can certainly look at the Board of Supervisors room, even if they chose to remote from the coast.
Right. I think they would still choose to remote from the coast, even if we're in the Board of Supervisors. I'm not speaking for you, Dan, sorry about that, but I think you live over there, right?
Yes, but 3 meetings of the year, the Board of Supervisors has an in-person meeting at the chambers later that day. So on those days, for sure, I'll be over in Ukiah.
is March one of those, Trustee Trudy?
I think it is.
Sorry to put you on the spot. If I'm hearing direction, I'm not hearing any objection to that direction. The next, I don't know that we need to do anything further as far as a vote on that. I would like to hear comment on the second item that the executive director mentioned regarding upgrading equipment in this room. And that doesn't have to happen today. We can bring that back.
I can bring back the more specifics of their proposals.
We could do that and ask for direction to the staff to bring back more specific details regarding the upgrading of equipment, of IT equipment in this room.
And maybe opening windows.
And open windows.
And windows. Any other? Go ahead, Trustee.
The benefit of paying by the hours, we might be done faster.
Yeah, maybe I'll start charging people by the word, then I'll be very sure.
Yeah.
Any public discussion regarding this or public comment regarding this item?
There is no public comment.
I believe we've given sufficient direction to staff. Is there anything else before we move on to the next item? Seeing none, just for the record, we have now lost Trustee Harris for her commitment at 11:15. So we are missing 2 trustees in this room. Item number 9 would be discussion regarding the administrative report. Executive Director Renschler.
Thank you, Chair Cromer. There is a factors legislative update attached to the report, and I just gave an update on pension gold, some upcoming trainings that I will be attending, and an update on the building. Our roof has a leak. It is currently tarped. We are waiting for the roofing company to come out and provide us with an estimate. Our local maintenance firm has requested that, but they have not been out yet for an estimate. But I'll bring back additional information as that is available. The request for qualifications for architectural services closed on Friday, and I did believe I wrote in Trustee Shoemaker to help review the firm's qualifications, and that would be Robert, I, and Trustee Shoemaker. I don't think that required a motion, but if you have any questions regarding anything on the report, I'm happy to address them.
My only question was if any other trustees would like to be involved in the review of the RFQ for the architectural services. We have 1 trustee on it. I'm not seeing anyone raising their hand quickly, so I believe that's sufficient with direction on that to involve him in the review of the qualifications.
Okay, great. Then we can move on to the next item.
Any trustee comments regarding item 9, the administrative report or attachments? Any public comment regarding item number 9?
There is no public comment at this time.
Thank you. Item 10, disability retirement training, Mr. Jeff Burke.
Okay, thank you. Judy, you gonna share your screen? So, some introductory comments as Judy is sharing her screen. I actually did this training for the board the last time 10 years ago. I think Trustee Shoemaker may have been the only person who was still here at that time, but I'm not sure. Anyway, the training in 2013 followed the adoption by the board of a document called Procedures for Disability Retirement Application and Formal Hearings. And it's a pretty meaty 30-page document. So, we went through and amended the procedures at that time, and the training followed it. The procedures document really gets into a lot of the substance in terms of the rules and the process that govern the filing of applications and the hearing process. Primarily, we're following the laws that are set up in the SERL, and then some case law that's interpreted those. There are a few areas where the board can kind of pick and choose a few things, but it's really pretty much defined by statute. This document that I'm referring to, the procedures, there's a discussion about the filing of the application and the medical reports that come in. And then the real guts of it is if there is a hearing that's requested by an applicant who's been denied, it kind of has all the details about how those hearings should proceed. And I'll go through all this in the training, but when you make your decision about whether to deny or grant an application, that's really an initial determination by the board. And then if the applicant wants to have a hearing, they can request it, and that's a big part of what this document provides. And then there's a decision by the hearing officer that would return to your board, and there are some options that you have at that point. And then ultimately, if either side isn't satisfied, it can go to court. So there's the administrative process first, and then it goes into court. There's another document that's also been created that didn't go to the board. It's more of an internal guide for staff and has some forms in it. It's also for the applicants so that they're familiar with the process. And that's called the Disability Retirement Application Handbook. So I just wanted to give a little bit of a couple introductory comments. And by the way, if you have any questions at any time, feel free to ask Kathy.
Are those on our website?
I believe they are, at least the procedures are.
Where do you find
Both.
those?
Oh, they both.
Under member forms and publications. In there. Thank you.
Great. So, Judy, please feel free to chime in at any point. So we'll go through the slides. And again, if you have any questions, please ask.
Sorry, my kids down. Alternate route. Okay.
So the first slide really kind of talks about the fiduciary duty that the board has both to the system and to the member. To some extent, it's competing interests, but you're to manage the assets of the fund and to grant the benefit if the benefit should be granted and provide due process as mentioned in that procedures document. So the first part of the training is about the process, the application, the investigation, and the medical reports. And so we'll kind of go through those. And I mentioned Judy already because she's the one that really handles a big part of, when the applicant walks in the door. And Judy really does a great job of walking them through what they need to do. And if you can go to the next slide, please. So it starts with the application. And it's obviously a very detailed application and includes significant medical information that's highly confidential and private. And there's reference there to the attending physician's report supporting the claim. That's really a critical document because, as we'll see in the slides and as you know from going through these applications, the applicant must show that they are permanently incapacitated. So if we can't accept an application, doesn't kind of meet that threshold test. So the attending physician has to say that their incapacity is permanent. Now, our doctors may or may not agree with that, but that kind of gets their foot in the door and gets the process started. Next slide, please. So the filing of the application, staff will review the application and counsel a member. All forms must be completed properly. There's a bullet point there about employer filed applications. We don't see this too often, but under the SERL, the law that we follow for everything that we do, an application can be filed by the applicant or it can be filed by the employer on behalf of the applicant. Next slide. This is an important slide. The deadlines for submitting the application, this comes straight out of the SERL code section. There's three ways they can do it. The first is while the member is in service, and that's generally what we see. If they do leave employment, they can file within 4 months after they've left. And the third, which we don't see very often, but we do from time to time, the SERL allows somebody to file an application anytime after they've left, even more than 4 months. But the key piece is they have to have medical from a physician that shows that they have been continuously and permanently incapacitated since the day they left. So that's a key piece.
Can I ask one question
Sure.
regarding the employer submitting
Yes.
the retirement paperwork?
Uh-huh.
Is that, I've heard of it because I know other surrounding counties do that. Can that only occur when an employee is basically considered permanent stationary and the office or wherever they work cannot accept or accommodate that condition?
So, with give editorial comment, sometimes there are different motivations of employees. And some may feel that they feel like they can return to work and they want to return to work. And they don't want a disability retirement. And the employer is saying, we can't accommodate you. You are permanently incapacitated and we're going to file on your behalf. You use the term permanent and stationary. And I'm glad you did because that's a workers' compensation term. And it doesn't mean the same thing as what we're looking at, which is permanent incapacity. Permanent and stationary just means you've reached a certain point medically where you're not going to get any better or any worse. They may be permanent and stationary and be able to do the job with or without accommodation. Did I answer your question?
Yeah, you did.
Great.
And I think in my line of work, that has another meaning because of the physical requirements of the job that I'm talking about, but I do understand your answer.
Great. So evidence gathering, very, very broad. And the SERL allows us great flexibility in terms of gathering information. We look at personnel files, we look at the medical files. If there's a workers' compensation claim, in most cases there is, but sometimes it's a non-work related medical condition. We get that file. We get a supervisor statement gathering all the information that we can. Risk management is involved to see that they've gone through the accommodation analysis. There have been times where we reach back out to the county, either through HR or risk, or sometimes the department and have some follow-up questions. We request medical reports, and there'll be slides coming up that we get them from our own medical experts, and sometimes we push back on them and follow up with questions. And that's the reference to that last bullet point slide about follow-up requests may be made. Witness statement's kind of a continuation of the last slide. The immediate supervisor's statement, any knowledge that they have about the injury. There's usually a document called the job description, and some job descriptions are better than others because we really want to have a good sense of both the physical requirements of the job, the essential functions of the job, and the mental stressors. So that's really an important piece when you're looking to see, what it is that the employee is and isn't capable of doing. And of course, their ability in the interactive process that the employer and employee go through to see if the employee can be returned to work, either in the position they were in, and that is the test. They have to be permanently incapacitated from their current job, even though they may be able to do some other jobs. And we'll talk about that in a little bit. If they can't do that, that's what the test is, permanently incapacitated from their current position. Next slide. So this is where we've gotten in the process where we've gathered all the information that we can from the employee and the medical providers and the employer. And then we take all that information and we give it to our doctor, our independent medical evaluator who conducts an examination. And they're given all that information, and we ask them some questions. And I'm reaching for that document now. So the questions that we ask our evaluator to look at is, does the applicant suffer from some type of an injury or disease? If so, does it render the applicant incapacitated from their usual job duties? We ask them to probe a little bit further to see if they believe that the treatment was proper, and are there other treatments that might be available? And what were the applicant's efforts to comply? Did they seem to, were they really trying to get better? Every once in a while, and this is a big picture overview, there's all these sub-issues and subplots, and sometimes you can get pretty deep into them. And some of these issues don't come up very often, but if there is other medical treatment, let's say there's some type of a surgery that might enable the person to come back to work, it's kind of there's definitely some subjectivity, and you look at the likelihood that the surgery would enable them to return to work, the medical probability of that, but it has to be balanced against the risk. I mean, there have been so many significant medical advancements in terms of knee replacements and hip replacements, but then there's risks associated with that as well. And so you look at that on a case-by-case basis. And if our evaluator disagrees with the opinions of any of the other doctors, to explain that. So they're really looking, though, at two main questions. One is the applicant permanently incapacitated from their job? And reasonable accommodation and that type of thing gets looked at in that analysis. And the second is if it's a work-related, a service-connected application, is it work-related? And we ask a very specific question of the doctor, and it's written out, and I'll read it to you because it's really important, and it comes from case law. And the courts have, frankly, made it a fairly low burden for somebody to show that it is work-related. So I'm just going to read you straight out what the question is that we have our IME answer, and it's based on case law. In your medical opinion, is the applicant's incapacity the result of an injury or illness arising out of the course of employment? If so, did the employment contribute substantially to the disability? And that is the term that's in the statute and that the courts have looked at and have said employment can be less than a 50% causal factor. So it can be less than more likely than not. But there must be a demonstrated and identifiable, real and measurable causal connection. So it can't be immaterial, but it doesn't have to be more likely than not.
So go ahead.
I did want to add that in non-service connected disability applications, we don't always go immediately to an independent medical evaluation based on the nature of the application. If it's a terminal illness or something like that, where all of the medical is pretty conclusive that that person has a limited amount of time left, we won't make them go through that process.
We won't make them go through and get an independent medical evaluation. And in those situations, our doctor actually sees the applicant and gives them an evaluation, but we will still have the medical advisor, which is the last bullet point on that slide, take a look at the record and see if they agree, and that should hopefully alleviate any concerns that a trustee would have about granting it. And Judy's right. I mean, they're usually really quite unfortunate circumstances where the person has a very serious and likely a terminal illness.
The one I was going to ask about is there's a certain number that are presumptive as well, was my understanding. That changes the burden to the county or the retirement association to prove that it's not as said or claimed, correct?
That's correct. In fact, I have some slides that talk about that. You're referring to safety members who have cancer or heart issues, and the presumption, they still have to prove permanent incapacity, but they're presumed work-related. And even without the presumption cases, you can see that it's a tough burden for us to show it's not work-related, and in a presumption case, even tougher. So the last thing I wanted to mention before we move on is the medical advisor. So MCERA has a contract with an organization called MMRO, which really over the years has really done a much better job about getting up to speed on the 37 Act, because they've seen a variety of issues now, and I think we're getting pretty good reports from them. But so where the IME, our medical doctor, gets to see everything that we have, the personnel file, all the medical stuff from the other side, the medical advisor gets all that plus the IME's report, and now does kind of a final summary, and we ask them to answer 3 questions. And these documents, by the way, the report from the medical advisor, the report from the IME, and kind of a memo that I generate, not that the trustee shouldn't review the entire file, but those 3 documents are really critical when you're evaluating the case. and they're very helpful documents for you to review. So the medical advisor, we asked them to answer 3 questions. 1, provide the opinions of the other physicians in the record. 2, describe why you agree or disagree with those opinions in terms of permanent incapacity. And then 3, if it's a service-connected application, whether you agree or disagree with whether it's work-related. So board action, I just kind of stole my own thunder a little bit. So staff and council review the file, and that consists of all the information that we've talked about in those 3 key documents. The application is placed on the board's agenda as a closed session item. Obviously, it's done in closed session. We're dealing with super confidential and private medical information. The board receives the file and council's confidential memo, which summarizes the information and addresses the legal issues for the board to consider. And without getting into any substance, I'll share that my memo has addresses 4 questions. And those 4 questions come from the procedures that the board adopted in 2013, kind of consistent with the CERL and what you need to know. 1 is the incapacity permanent? 2, is it work-related? 3, if the member is under 55, should there be ongoing medical review? And there'll be a slide that talks about that in a minute. And then the last one, and there is a slide that talks about that as well, which is if you do grant the application, what should the effective date be? So now we get into the legal standard, and we've talked a little bit about some of it already. Next slide. So for service-connected or work-related disability retirement applications, you could work 1 day. You could be a deputy sheriff who just started and you haven't even left the academy yet, and you could suffer an injury. And I've actually seen those cases, but they're already an employee. So if something happens on your first day of employment, you're permanently incapacitated, and it's work-related, you're eligible for the benefit, which is 50% of your final average salary, and that amount, according to IRS rules, it's in the it's akin to like a workers' comp benefit. It's tax-free, and whether it's tax-free or not, by the way, I just give you that for your information. That really shouldn't be a factor in deciding whether or not to grant the application. So it's the higher of 50% or service retirement, that's higher. The excess over 50 is not. It is.
Do we ever have that situation?
Where it's, yeah, sometimes they've worked for a very long time. Yeah. And there's a 100% continuance for the spouse or domestic partner if the application is granted and it's work-related.
Does that contain the same 1-year requirement that they had to be married for a year prior to separation from employment?
Say that again?
I believe for a standard retirement, or to have the continuation of the spousal benefit, they have to be married for a year while they're contributing to the system.
For the 60% continuance of the unmodified option, not only do they have to be married when they left employment, they had to have been married at least 1 year prior to the date of retirement.
And you're saying, is that the same?
Is it the same?
I believe that it is.
Okay. They couldn't have been married 1 day and then he or she gets permanently disabled.
I don't know that for sure, but I believe, I don't think there's a difference.
Okay.
For non-work related, the key piece there is that you have to have 5 years of service to get a non-service connected disability retirement. And the benefit is up to 1/3 of your final average salary or service retirement if higher. And there's the regular 60% continuance. So permanency, talked a little bit about that already, and it's where further change is not medically anticipated. You've reached maximum medical improvement. You've exhausted all the standard medical treatment, unreasonableness in complying, and there's no accommodation that will enable them to return to their position. And again, I mentioned this before, what incapacity is, it's the essential functions of their job, not some other job at the county, or whoever the employer is. So so sometimes the doctor will say, you know, maybe it's possible for them to keep going, but the risk is so high that if they suffer, you know, another injury, it could be so severe that it's kind of a prophylactic restriction and also entitles them to the benefit. There's a provision in the SERL, the last bullet point is this transfer position. It does not come up very often, you know, rare there. And what's going on here is, if it is found that they're permanently incapacitated from the job they're in, employers are still required to go through the accommodation analysis to see if there may be other positions at the county or the employers that are vacant for which the person is medically and educationally qualified for. And in very rare cases, somebody doesn't want to leave employment and they're willing to take a different job. And if it pays less, then the system makes up the difference. But it's voluntary. The applicant has to agree to take that other position. There's no requirement for them to do it. So we don't see it very often.
Something else that came to mind was exacerbation of a prior injury. And at times when employees do try to return to work multiple times, go back out again, they have an exacerbation of their medical condition. And we've also seen applications with that issue as well.
And I think there might be some slides that talk about that, maybe in a slightly different context, about maybe medical condition that predated them becoming employees here. Let's keep going. So service connection, how do you determine the work relatedness? And I kind of read you the question and I told you that comes from case law and also the statute. So there it's kind of laid out again. And Judy's comment about aggravation and pre-existing conditions. But so the work relatedness, there has to be substantial evidence of a real and measurable risk. Less than 50, but more than 10%, I think, is came out of the court case. So that's that kind of gives you a sense of the burden here. The last bullet point is, you know, when somebody is hired for employment, they generally go through, especially if it's more of a safety sensitive position, a pre-placement medical evaluation, or at least some type of a questionnaire. I suppose not all employees go through a medical evaluation, but I'm not quite recalling. But once the employer takes on an employee, they've gone through whatever due diligence the employer gives. And so at that point, it's kind of presumed that they are able to do the position. So, you know, they may have had some kind of a pre-existing condition, but they've been hired and they're doing the job at least for some period of time. So I know that may get frustrating sometimes to boards who have to approve these applications. But a pre-existing condition that's aggravated by job duties is deemed to be a work-related condition. And that speaks to the last bullet point, which is the employer takes the employees they find them. So it's really incumbent on the employers to do a decent job when at the time they hire someone. Service connection disability is not service connected. And again, remember, we've kind of got a difficult burden to say it's not work related. The link between the job and incapacity is speculative or incapable of being quantified or measured in that kind of line of cases. If it's just a temporary flare up, you know, that's not going to qualify. That really almost more goes to permanency, I think, than service connection. Next slide, please. So the presumptions, they're there from the SERL, heart, cancer, and then those are rare, and then the others are even more rare. Bloodborne infectious disease, biochemical substance. So these are really benefits that the legislature put in for safety members. And the presumption means that they still have to prove permanency, but the burden kind of shifts to us if it isn't kind of already to show that it's not work related, and it's pretty difficult to meet that. So the next two slides talk about the heart and cancer presumptions. So here's the cancer one. So again, they have to have 5 years or more of service. So we're talking about safety members only. They develop cancer, and the one piece they do have to show is that there was some type of exposure on the job to a known carcinogen. So they do have that burden that we have to see medically and substantiated in some fashion. And if so, then the presumption applies, can't be attributed to a pre-existing condition. And the only way to rebut the presumption is to know what the site of the cancer is, and then get a medical opinion, an expert medical opinion to say the carcinogen isn't linked to that cancer. Very rare that you have these cases. Heart presumption, 5 years again, have to show permanent incapacity. They have some heart issue that renders them permanent. The presumption applies, and you're going to have to show some type of non-work related something is really what caused the heart condition. It is a rebuttable presumption, so I talk about the ways that we try to show that, in fact, it's really not work-related. And it's a fairly tall burden for us. Post-approval considerations. I mentioned to you one of the questions that I'll address in the memo for you, and we've asked the IME to address, is whether if the applicant is under the age of 55, and you're going to grant the application, should we require them to undergo further medical evaluations to see if their condition changes and they'd be able to return to work? So we can do that. However, even if you have a situation where the application is granted and a doctor in a later exam says, you know what, they can return to work, the employer still has to take them back. And if the employer doesn't want to, I don't know that I've really ever seen that even happen, let alone whether or not the employer wants to take them back. It's very rare. But it is there, and we have sent folks who've been granted applications back to the doctor even after they've been granted. But I haven't seen a case, I don't recall, Judy, correct me if I'm wrong, but I'm not recalling any where they actually changed.
We did implement a procedure from Sonoma County with a questionnaire that is sent to the member that's receiving the service-connected disability benefit. And we ask them questions pertaining to their current medical care, their treatment, their current medical status. We receive that back, and we use that as a guide to judge whether or not an additional independent medical evaluation is necessary.
But I've never seen a case where the doctor's actually said, now they're good to go.
How often do they get sent that questionnaire?
It should be an annual follow-up
Until they reach that age of 55?
until they reach 55. However, in a number of our disability cases, the recommendation from our medical advisor would indicate that there's no follow-up required. If you've noticed that in those MMRO recommendation reports and in Jeff's memos, we may indicate that there is no requirement to do, I mean, there's a legal requirement, but our medical advisor doesn't believe we need to conduct that follow-up.
And is there a process if that member doesn't answer or return your questionnaire? Does that ever happen?
That has not happened, but we will take that as it comes.
Yeah. Understood. And then
we could send them for an evaluation.
Yeah.
And if they don't comply with getting the follow-up evaluation, that would actually be cause their benefit to be terminated. That's, again, very unlikely. I have seen instances where the doctor said, this person actually could probably return to work and they're deemed no longer disabled. but the employer doesn't want to bring them back on board, so it has no impact on the benefits actually being paid.
And that was my next question. I've never heard of that either. But if it did get to that point, the employer said, we don't want this person back in employment, they would still get the same benefit they're receiving the month prior.
Next slide, please. Determining the effective retirement date. So this comes out of the statute as well. The retirement date is determined based on the date of the application, but no earlier than the last day in paid status. Obviously, you don't want them getting paid their salary and a disability retirement benefit, so you don't want them double dipping. Staff determines the last day in paid status from payroll records. Some of you may recall there was a little catch with them getting a one-time payment, and then we had to have them reimburse that one payment so that we could wind the clock back based on this last point called the delay exception. So this is something that comes out of the statute. So the day they file their application, remember, they have to show that they're permanently incapacitated. That may have been a year in the making because maybe they couldn't work for a year, but they were only temporarily disabled, so they're on leave without pay for a year. So now they have a gap of a whole year. And this is designed to address that, to make up for the fact that they really were permanent from day one. It just wasn't known medical yet. But a lot of times employees, of course, go back to work. In fact, in most cases, they do go back. It's the rare case where they can't go back. So this allows the retirement board to say, okay, yeah, given these facts, and that's why we'll say their last day in paid status was September 1st, so you should make the retirement effective September 2nd, even though they didn't file for a year, because they couldn't, because they weren't permanent.
So in those cases, Jeff, where they have retired standard, we'll just call it standard retirement, and then later, even years later, file something showing that it was a service-connected disability claim, would it go, if they have to prove that it occurred, it existed before they retired, would that go all the way back to their retirement date?
So they can't double dip, but to the extent that there was some lost benefit, that would create that delay exception.
The Bureau does allow a member to receive a service retirement benefit while their disability benefit application is under review. And that process can take a large number of months sometimes to collect the records, to get the IME, etc. So in those events, if a member opted to receive a service retirement while their disability retirement application was pending and under review, we reverse those benefits and pay the difference between the service and the disability benefit when they get converted and brought up to date.
So it'd just be the difference.
Correct. There wouldn't be any double payment.
That's why I assume, but it could go back for potentially an extended period of time to pay that difference.
Had some go back a couple of years, I think.
We have that.
Okay.
Next slide, please. So the board makes this initial determination about whether to grant or deny. If the application is denied, the applicant can appeal that decision, that initial determination, and ask for a hearing before a hearing officer. And you see there's a point there about the 2013, the procedures for conducting hearings, the procedures define and lay out what the process is. A hearing officer is selected, a hearing is held, and I should mention, because we haven't had one for a while, I believe that if we had a hearing, it would be, I'm counsel to the board as the advisor, and the prosecuting attorney, if you will. We use Sonoma County Counsel's Office to be the attorney who represents Sarah in this hearing. And, we kind of create an ethical wall between the person who's doing the hearing. They just get the file and they take the case and they, explain to the hearing officer why the application should be denied. And the applicant can be represented by an attorney, and they have a hearing. It might take a day or 2 days, and it's really based on the medical reports, right? And then the hearing officer writes a recommendation, a recommended decision that comes back to the board. And the SURL and our procedures define then what you can do. You can accept the decision, you can reject the decision. It even allows you to hear the matter yourself if you want to.
We might want to move to the next slide so the people on Zoom can see what those conditions are.
Oh, great, thank you. So there they are. So you can approve or adopt the decision. You can require a transcript, a summary of all the testimony, and, you know, maybe make a different decision. At least you've had the opportunity to hear what was said and what the testimony was. You can refer the matter back with or without instructions to the hearing officer, or set the matter for hearing yourself. And if you do that kind of a hearing, the hearing officer's decision plays no role at all. You make a complete independent decision. If the applicant is not happy with the final decision that's made after, you know, it's gone to a hearing officer and then back to the board, that was the administrative process. They can then file what's called a writ in Superior Court and ask a Superior Court judge here in Mendocino County to give them that benefit. What's interesting about writ proceedings is there's no more live testimony. So it's just argument. Both sides argue the case before the judge, and there's a record. And there's a record of what the medical reports were, what the testimony was, and the judge makes the decision based on argument and the record only. It's pretty rare to get to that stage. Any questions?
It takes a lot.
I keep thinking about the people I've known over the years. It didn't work out.
I appreciate the overview. I certainly very much focus on the letter that you write to guide where I'm going to look next whenever we get one. And I hope that's the intention of that document, because those are the 4 questions that I'm looking to answer. My main questions, which you and I have had conversations about, are when there is concern or suspicion as to the alleged injury or anything else. And I understand there is a process, and I hope the other trustees understand there is a process when the board believes there's deception or issues, that there is a process that can be followed to further investigate that. And I don't know what we're talking about, but to understand the process exists, I think is sufficient to bring up at this point. Any other trustee conversation, questions, comments?
I think not having had that presentation, because I haven't been here 10 years, I've picked up on lots of it because of the work we do, but to have it all put together in one place, I don't think.
And it's good to look back at it for when we encounter one of those abnormal claims. We say, I'm going to go look at Jeff's presentation again, and hopefully be my own resource to answer some of those questions I might have. So I appreciate it as well. Any public comment? It's a training, so I hope not. It isn't.
There is no public comment.
I will comment that this training does count towards your educational requirements, so Judy will make note of that you received this training at our meeting.
Thank you. Thank you, Jeff.
Sure.
That brings us to item number 11, general board member discussion. Do any trustees have items they would like to discuss as general board member discussion?
I have about 3 pages of notes.
Okay.
We'll keep you here another half hour.
Trustee Hawkins.
Just something really quick. I was approached by Patrick here at the union next door, and he asked me to find out what he would have to do to get a calculation going back those people that are PEPRA members for in January 2013 when they were at that point denied the cost of living adjustment.
What type of calculation are you wanting?
He's wondered how much it would cost to bring the PEPRA members up to speed on being able to get their cost of living adjustment.
Well, the PEPRA law, when it was enacted, prohibits any retroactive adoption. So even if this board decided to provide a COLA, it would only apply prospectively going forward. There wouldn't be any way that COLA would apply to the years of service that have already passed for current members. But the process, I would not be familiar with. I haven't had it come up, but I'm assuming it would involve an actuarial study, and then of course it would involve contributions made by behalf of both the employee and employer going forward.
Yeah. And to be fair, it's my recollection that the decision regarding the COLA was a decision by the Board of Supervisors. We just administer that benefit. So I think, although that question is more of an actuarial question, the concept of changing the current language would be more better proposed to the Board of Supervisors.
Yeah, that's my understanding.
And if the Board of Supervisors were to consider that, they would be required by law to obtain an actuarial study.
If that makes sense.
Yeah, I think he's hoping to use it for future negotiations. The MOU has some language in there that it's open to negotiate in the future.
Understood. The only thing I would like to mention is that I do have a pre-planned and paid for vacation in June, so I will be absent during that meeting. And the only reason I bring that up is the executive director's evaluation. There's some important steps during the June meeting that are occurring. I have checked with the vice chair, and he will fill in for me during my absence. So for the schedule of that, I believe in May, I will send out the questionnaires for comments and input and evaluations. Instead of those being sent to me, they would be sent to Vice Chair Shoemaker, who would compile them for the June meeting, get a final draft in closed session from the trustees that would be put together, I believe, with the assistance of Trustee Smith, and then sent to the executive director the final draft before, with proper time before the July meeting to go over that. So I just want to make sure everybody aware that we'll follow the start process and the end process of that, but the June part, Richard would be filling in my absence. Any other trustees have any other general board member discussions or items? All right, it'll be notice of that item 12 is notice of the next Board of Retirement meeting, which is Wednesday, March 15th, 2023 at 08:30 hours, and we are adjourned.
Thank you. And we are going to meet.
I'll contact the executive office to see if I can reserve that room. If nobody else is using it and it's still available, we should be able to have a meeting there in March.
So for the supervisor's chamber. Okay. Thank you, everybody.
So this meeting.
Thank you.
Thank you. Yes, this would have been a $300 meeting.
And if we are going to have it there, it'd probably be good if we put some kind of notice on the website. I mean, not that we can